think the price action's reasonable right now.
There's just too much uncertainty about these larger narratives.
I think it's a buy incrementally less America moment.
There's still some more room that you could fall.
The equity market is going to have a hard time making that next leg higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. Crude pairing gains following the biggest two-day rally in almost 6 years, as President Trump is attempting to support shipping through the Strait of Hormuz. And reports suggest Iranian operatives have reached out to discuss ending the war. That report is supporting sentiment this morning.
Okay, there are a couple of takeaways here from this report that isn't verified. And to be clear, is back channels discussion through another country's spy agency talking supposedly with the CIA operatives, and people don't know how serious anyone is. The fact that markets want to rally gives you a sense of people wanting to buy this dip, still wanting to hope that this is going to be temporary. On the flip side, it highlights all of the thorny questions like who's in charge in Iran? Who does President Trump want to be in charge in Iran? And then how can anyone rebuild trust in this type of circumstance?
This war is ongoing. This conflict is arguably still escalating. This from the UAE just moments ago. They intercepted 3 missiles and 129 drones just today. And the president's trying to support traffic through the Strait of Hormuz. And this is what he's trying to do: provide a framework for insurance and escort ships through the strait. In his own words, no matter what, the United States will ensure the free flow of energy to the world. The President of the United States. This is the reaction we've seen on Wall Street. RBC, we question how much planning has been done on the insurance backstop. This from ING. Naval escorts will be sitting ducks to Iranian attacks. This is easier said than done.
And frankly, getting people's confidence that they're not just going to be shot down is different than saying we will escort you, especially because it hasn't happened yet. You also are seeing a lot of ships already getting rerouted, and already the stockpiles are full, which is a reason why you're seeing production being halted in different places. What President Trump wants to do is to invoke the U.S. International Development Finance Corporation to support some of the insurance to back these ships. That alone is going to take time. So even if there is a mechanism to do that, there is some friction between now and when it could actually get implemented.
But I'm with you on the market side. We haven't seen tremendous damage at the index level on the S&P 500 this morning. European equities supportive. Bond yields are off the highs. Haven't seen a new high intraday on crude for about 24 hours now, off that 85 level we broke through yesterday. So some subtle signs that markets are adjusting and have completed that adjustment.
When you talk to investors, they want to look through this. They want to look through geopolitics. They always say this is not going to be something that determines for a longer term unless it goes on for a long time. And they talk about the solid fundamentals. That's the reason why the pillar of what we get on Friday, the non-farm payrolls report in the United States, could be really important. Does it confirm that strength, or does it potentially throw a thorn in that particular narrative?
So what matters to markets at this point? This from SocGen. 1, the shock duration, all on board with that. And 2, the Fed's reaction function. Later this morning, in 2 hours and 30 minutes time, we'll catch up with the biggest dove on the FOMC, Governor Miran, and a lot of questions for him as to whether this shock matters to how they set policy.
Especially because Neil Kashkari of the Minneapolis Fed, speaking to our own Michael McKee yesterday, said it potentially could take a rate cut off the table for this year, talking about how right now it's too soon to know what kind of effect this would have on inflation. Typically, the Fed looks past these types of shocks. Do we get the same kind of view from Stephen Miran?
Brent crude this morning, 82.65, WTI 75.28. Coming up this hour, we'll catch up with Sébastien Page of T. Rowe Price, with global markets whipsawed by the Middle East. John Lieber of Eurasia Group as the White House looks to support shipping, and Paul Sankey of Sankey Research following oil's biggest two-day gain since 2020. We begin this hour with stocks looking to recover as geopolitics fuels major volatility. Sébastien Page of T. Rowe Price writing this: the bear case is a prolonged war, prolonged closure of the Strait of Hormuz, and escalating attacks on energy infrastructure. Our Brent range then would be 100 to 120. Sébastien joins us now for more. Seb, welcome to the programme. That's the bear case. What's the base case?
You know, our research platform's been on overdrive over the weekend, as you can expect. And I've been reading the research from our analysts. And, John, I can say there is no base case. It's extremes on both sides. I hate saying the range of outcomes is wide because it always sounds like an out. But we have 2 scenarios, one short, one long. And the short scenario, I think the Wall Street Journal reported that this is a bit of a race in terms of the missiles and drones from Iran and then the defenses from the Gulf countries that both are running out. And then you just reported on news that There's some, I don't know if you call it rumors or something else, but there's some news items that are pointing towards the short scenario. And then the long scenario is an escalation, and you just outlined it. So, John, there is no base case. We're looking at scenarios. That's the only way to manage this right now between short and long. And what we want is, geopolitical hedging in the portfolio, which we've had for a while. So we remain long real asset equities, and including energy, but also metals and mining and commodity stocks.
Seb, where do bonds fit in as we confront a shock like this one?
Yeah, that's a tough question. I'm a bit of a correlation nerd, and one of the studies I've done is a study of a correlation between stocks and bonds. And if I were to boil it down, because we talk, and I know in surveillance we talk about this, we talk about stocks and bonds and the stock-bond correlation. You can boil it down pretty simply. If you get an inflation shock, both stocks and bonds can go down together. If you get a growth shock, then I still believe, and the evidence is there, that treasuries remain a hedge for a growth shock. Now, these things are always ingrained, so it's which factor dominates. Well, if you look at the current situation, the inflation risk is clearly there. One of our analysts studied, several oil shocks, and he calculated that peak oil on average occurs 23 days after the beginning of the attacks or the military intervention. And then that oil rallies on average 27%. Again, these are averages, a mix of extremes. The range of outcome is wide, as much as I hate saying this. So it's a matter of hedging. And you'll see that in those cases, when oil is driving and when inflation concerns are there, and you saw the one-year inflation swaps go up around these events, well, then bonds are not the same hedge as they used to be. And you have to have alternative hedges in the portfolios.
Sébastien, how important is non-farm payrolls on Friday in light of this, given the fact that a lot of whether this is an inflationary shock or whether this is potentially a shock to growth is predicated on how much momentum there was heading into this?
Look, I think the geopolitical headlines will continue to dominate into Friday. Non-farm payrolls are always important. No single data point matters, but we still debate employment quite a bit in our asset allocation committee, especially in the context of AI. I believe the unemployment picture is okay in the U.S. for the time being. We're still at 4.3%. I always remind people that the long-run average unemployment is 5.7%. So the economy in the U.S. is humming. Of course, if you get a tax on the consumer in the form of higher gasoline prices, and then that can change the picture, but that won't be in the non-farm payroll numbers on Friday. So I guess, Lisa, I'll say moderately important. It's part of the mosaic. And we have to, I like the question because sometimes we get carried away with geopolitical headlines. Of course, this is a major event. It's just like, it's in some ways, another word I hate to use is unprecedented. But I'm using all the words I hate to use this morning. But, growth and inflation are still major forces driving the U.S. economy. And if we're running at 5.5%, 6% nominal growth, stocks should do okay. And by the way, there's a nice study by Merrill Lynch that shows that about 60 years of geopolitical shocks and 70% positive stock returns after a year and an average of 9.5%. So that kind of sets this narrative as you buy the dip and it's a buying opportunity when you get a geopolitical shock. But I think the picture right now is more nuanced, and we're advocating for hedges, including in the stocks portfolios, including real asset equities.
Sébastien, I'm going to give you another word that you probably hate using. Is this market virtually untradeable based on the lack of fundamental backing behind a lot of the potential moves?
Untradeable. Here's another one, Lisa. Thank you. I think that markets are deep and liquid, and we talked about treasuries. I mean, those can remain a hedge if we get a growth shock, which I don't necessarily expect. That's not the base case. You see oil markets behave. We're already in the 80s in crude. It's been interesting to follow the oil price reaction on my Bloomberg terminal, from this idea that we'll escort ships around the Strait of Hormuz and that we'll insure them. And then, you saw oil prices come down a little bit, but then this morning it looks like, we're back up. And so you were just reporting about Wall Street skepticism. I think this is hard to do. But overall, markets are behaving, Lisa.
Seb, we're confronting a lot of shocks and have done over the past month or so. I think there's three broad shocks. AI disruption being one, the second being the jitters in credit, and now the third, the energy shock over the weekend. I'm interested in 2 and 3 and the interplay between both. The credit jitters need a rate offset, and I just wonder how you are thinking about the prospect of the rate offset being constrained by the story developing, which is 3, the energy shock. We're not getting a loosening of financial conditions, we're getting a tightening of financial conditions at a time when credit jitters are heightening. They're not de-escalating. And I just wonder how you think that's going to play out in the weeks to come.
Yeah, look, the major risk for multi-asset investors is that the treasuries don't behave as you need them to be when stocks sell off. But I think I heard Lori Calvasina say on Surveillance earlier this week, let's all take a deep breath, right? Right now, stocks are doing okay. And I think there's this narrative that geopolitics won't drive everything. You know, John, you have an AI tool now on the Bloomberg terminal. It's in beta version, right? But I was using it just for fun, and I thought I mentioned it on the show. And I was looking at, okay, what's the relationship between oil and stock prices? And only 6% of stock price volatility over time, not during specific events, can drive the S&P 500. So it's a lot of different factors playing all at once. AI is a huge debate on our asset allocation committee, especially in terms of what it will do to employment and how fast. Some of us are saying, look, it takes a lot of resources to clean your data and tag your data and upgrade your infrastructure. So maybe you're actually hiring people to deploy AI. This is just me being controversial, but then we all know that over time, it can replace jobs. And how is this going to play out? I was driving to work earlier this week, listening to Bloomberg Surveillance, and my drive's about 30 minutes, Jonathan, and it was 30 minutes I got to work, and there was no discussion on surveillance of AI because of all the geopolitical risk, right? And so I was like, wow, they haven't talked about AI or the Fed even once, and I'm at work already. It's been 30 minutes. But those factors, let's not forget them. They still matter very much in portfolios. And before all this happened, we saw industries fall one after the other, which we ended up debating in our asset allocation committee. It's this idea of dispersion, John, and that's going to continue, dispersion across industries. Our portfolio managers like healthcare stocks. It's interesting. They like technology, but they also like materials and, even energy stocks.
Seb, as they say, we can only focus on the shark closest to the boat. There are a lot of sharks out there, but the shark closest to the boat right now, the shark over the weekend. Sébastien, it's good to see you, as always. Sébastien Page there of T. Rowe Price and the author of The Psychology of Leadership. The psychology of this market right now, you indicated you think this is a market that wants to rally.
Clearly, that was the reaction in terms of any little catalyst, no matter how small and how second or third or fourth hand it is, giving people an impetus to buy. That said, what you said, the question that you asked, Seb, I think was a really important one. How much do a potential increased tightening of financial conditions tied to an oil shock affect the credit jitters that we're seeing? Does that accelerate some sort of shakeout and create a more violent, if maybe a shorter period of time in which this happens? Increasingly, this is what a lot of people are focused on.
That market needs an offset, and right now, it risks getting an accelerant, and that's a problem. Equity futures at the moment on the S&P positive by 1/3 of 1%, with an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iran is ready to negotiate with the U.S. The New York Times reporting that Iranian intelligence operatives reached out to the U.S. government a day after the attacks began to discuss ending the conflict. After saying for days he was open to discussing a deal with Iran, President Donald Trump posting on Truth Social on Tuesday morning that it is now, quote, too late for talks. President Trump also saying the U.S. will provide naval escorts to ensure safe passage for oil tankers and other vessels through the Strait of Hormuz. The president also saying the U.S. International Development Finance Corporation will offer insurance at, quote, a very reasonable price to help maintain the flow of commercial trade in the Gulf. And the South Korean Kospi suffering its worst one-day sell-off on record, plunging 12% in today's trading, following a 7% drop yesterday. The index seeing an AI-driven rally this year that sent it higher by more than 20%, while the S&P has turned lower on the year, currently down by 0.5%. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. The big winners of the year so far, the big losers of the week so far. Up next on the program, a pressure point for crude.
If we have a little high oil prices for a little while, But as soon as this ends, those prices are going to drop, I believe, lower than even before.
Up next, we'll catch up with John Lieber of Eurasia Group from New York City this morning. Good morning. Equities off the lows and crude off the highs. Equity futures this morning positive by 0.4% on the S&P. On the Nasdaq up by 0.5. The Russell outperformance there up by 0.9. Turn to the commodity market, crude specifically. Almost 24 hours ago to the second, that was the intraday high for crude just yesterday. $85 a barrel. This morning, $82.56, so just off those highs. Positive on the session, but off those highs. We're up by 1.3% so far. Under surveillance this morning, a pressure point for crude.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible.
So here's the latest this morning. Iran reportedly coming to the negotiating table. The New York Times reporting Iranian intelligence operatives approached the US government over the weekend with an offer to discuss terms to end the conflict. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Jemana Besechi in Dubai. Tyler, I want to come to you first. The headline from the New York Times is encouraging. I think the substance less so, and the date of the outreach specifically. Can you go through the details?
Well, hey, John, good morning. I was in the Oval Office yesterday where President Trump maintained that the U.S. is going to sustain this military operation until all of its objectives are achieved. And the New York Times is even reporting that the sense from U.S. officials is skepticism that there could be a diplomatic off-ramp at the moment. And it's still unclear if Iran even wants a deal, too. Now, President Trump did say yesterday that the potential worst-case scenario would be if new leadership emerges that's, quote, just as bad as the current regime that the U.S. and Israel are trying to change. The president himself said that he hopes that a new, more moderate leader could emerge that the administration feels that it could work with, but then also mentioned how most of those top contenders that the White House had been eyeing have been killed in airstrikes. In fact, Bloomberg News is reporting that the Israeli military appeared to target a meeting of the coalition that is currently tasked with choosing the next supreme leader just yesterday. Now, President Trump, as you know, has also called on the Iranian people to take over their government as well. So there's big questions here about exactly what the administration would like to see when it comes to an outcome in future leadership in Iran. And a lot of that has to do with the timeline and how long this military campaign can go on. Now, John, as you mentioned earlier in the program, amid these questions about the timeline, President Trump did take action yesterday to announce that he is trying to stave off a potential energy crisis with this announcement of potential insurance guarantees and a naval escort. I will point out that he met yesterday with his top energy and treasury advisors, Scott Bessent and Chris Wright, about a potential plan to help those energy prices here at home.
Well, let's talk about that energy plan, Jemana. Let's focus on energy specifically. The president offering vague details of a plan with two key pillars. One, provide a framework for insurance, and two, escorting ships through the Strait of Hormuz. How well received has that plan been over in your region?
Yeah, well, I think earlier in the show you were saying that there's a bit of skepticism from the analyst community as to exactly how it's going to be implemented and which companies are willingly going to take it up and expose their vessels to some of the risk. Earlier this morning, the Revolutionary Guard once again reiterating that they have, and this is what they're asserting, full control still of the Strait of Hormuz, which is effectively shut. And you have to think about two things that are going on right now in the energy world. Number one is the effective closure because vessels are not transiting through the strait. And the other is ongoing attacks on key energy infrastructure sites around the region. Yet another attempted attack this morning on the Ras Tanura refining facility in Aramco. And that is the largest refiner in the Middle East. So this tells you, Iran isn't letting up. And I'm just going to leave your viewers with one statistic that I think is really relevant here because they continue to lash out at Gulf states. In the 12-day war, and this is Iran-Israel, Iran sent over a total of 1,500 missiles and drones towards Israel. In the first 4 days of this war, they sent over 1,800 to the GCC states. And these are countries that Iran has diplomatic relations with. So most definitely you can say that there has been a broad escalation, and there are no signs really of things letting up right now.
Without a doubt. Jemana, thanks for that. Jemana Pasechi alongside Tyler Kendall. To build on the conversation, John Lieber of Eurasia Group writing the following. The Iran conflict will likely taper off within 2 to 3 weeks as the US and Israel successfully degrade Iran's military capabilities. John joins us now for more. John, welcome to the programme. What gives you the confidence that we'll end this in a 2 to 3 week time frame?
I mean, I don't have a ton of confidence that this is going to be over then, but there is an issue where the military capabilities just aren't going to be what they were when this whole thing began. So the Iranians eventually will run out of ballistic missiles. We just heard about the large number that they've been launching against other countries in the region. Eventually, you know, they do have a large quantity of drones that I think the U.S. is going to have trouble getting access to before they're launched, which means that Iran's offensive capabilities will remain fairly aggressive for the immediate future. But at some point, this is going to taper off when they start running out of ballistic missiles and the U.S. starts to run out of its ability to defend its own ships in the region. Now, I think if you listen to what Donald Trump has been saying, he's been pretty explicit that there's more to come here, that this is kind of the initial phase of these strikes. And we think this probably escalates over the next several days to maybe a week or so as the U.S. tries to end this quickly. The U.S. does not want to be in this war for the long haul. Now, of course, they're going to remain committed to the region because what they need is regime compliance, not regime change. And the way that they enforce regime compliance is by maintaining a credible threat to bomb whoever is coming next. So, but we think the most intense part of this fighting likely tapers off in the next few weeks.
How concerned are you, John, about the asymmetry in cost between what the U.S. is deploying and what Iran is deploying? And I'm thinking about all those drones that you said are going to be hard to identify before they're launched. The U.S. is shooting them down with million-dollar missiles. Each of those drones is relatively cheap to produce. How much of a problem is that?
Yeah, it's a huge problem. I mean, the advantage here, of course, is the U.S.'s industrial capacity, which over time is going to be able to make sure that those ships are resupplied at any cost. You know, Trump is trying to increase the defense budget. It seems like Congress is more or less willing to go along here. So the U.S. has a large store of production capabilities that it can draw on with time. Iran doesn't, and it won't. It probably has these stocks of drones. It's got these stocks of missiles. It will run out of them at some point, but they can cause a lot of damage in the meantime. And that, I think, is the major concern for Gulf partner states around Iran right now. Less of a concern for Israel, given the distance that Israel has from Iran.
John, just quickly, how did you and the team react when you heard the president's vague, I would say, framework to help traffic through the Strait of Hormuz?
You know, this could work. I mean, if I'm a shipper, I don't want my tankers destroyed or sunk, so it's obviously quite risky. But the U.S. is now putting taxpayer money behind ensuring that these ships can get through. I think we have to wait and see what the details look like. Legally, it seems like he probably has the authority, some flexibility in the DFC in order to do this. But I think that, you know, and clearly they've thought this isn't a totally slapdash plan. I think that they actually do have some reasonable planning behind this that suggests they will be able to compensate for losses. The question is, are shippers willing to take those losses and then and take that risk?
Hey, John, it's good to see you. John Lieber of Eurasia Group. Two different ways to talk about this. The policy experts will look at this and they'll be very sceptical. The market participants will look at this and say this signals a degree of sensitivity to what's emerging in the Middle East. And you're going to see more.
There could potentially be some sort of, dare I say, put from the White House to cap some of the volatility and, frankly, some of the violence that we've seen.
You can judge which is the best way of looking at this right now. Equity futures, session highs up by 0.4% on the S&P. Up next, we'll catch up with Paul Sankey of Sankey Research with crude coming off its biggest two-day gain in almost 6 years. Programming note for you, it's about 90 minutes away, so 8 a.m. Eastern time. You'll want to tune in for this. The U.S. Secretary of Defense Pete Hegseth, alongside the chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon. Again, that's taking place at about 8 a.m. Eastern time. We'll bring you some of that a little bit later. At the moment, equity futures doing okay. with the emphasis on OK. Equity futures right now up 1/3 on the S&P, off session lows on the Nasdaq, up by 0.4. As we turn to the bond market, 2s, 10s and 30s. Yields look like this morning. Two-year yields just about unchanged after repricing higher over the previous few sessions, 351.24. And in commodities, we are off the highs of crude from yesterday, $85 a barrel briefly at 6:18 Eastern time in yesterday's session. This morning, we're back to 82.15.
As they look, traders look for some sort of off-ramp and the potential for one that was raised in the New York Times article. I think you framed it really well about how a lot of people in the policy world are saying there's a long way to go between this story about fourth-hand discussions about somehow getting an off-ramp and somehow getting to an end of the war. People want this to be short. The market believes that this will be short. The market is trying to hedge on the margins that it won't be, but doesn't want to, and that's what we're seeing in the market this morning.
The piece from the New York Times came out about 30, 35, 40 minutes ago, and this is ultimately the essence of it. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. I'm reading that verbatim from the New York Times. That's according to officials briefed on the outreach. Now, I think the date's really important. That's the day after the conflict started. I've got no idea if those operatives are still around, given the amount of damage done to the leadership in Iran. And if the off-ramp was there, it certainly wasn't taken, given the events we've seen take place over the past few days.
President Trump alone said, look, so many of them are getting wiped out. I don't even know who any of them are anymore. And this raises this question, who's in charge? Who does President Trump want to be in charge? How do you find the elusive moderate in Iranian politics, which has been something that has sort of been the holy grail over the past decade or so? And so there's a real question here, how credible an off-ramp really looks, given all of these potential constraints.
Futures doing OK, up 1/3. Let's get you some single names as we count you down to the opening bounce. Some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Raw Stores. Shares are surging 7.7% after the off-price retailer delivered a strong earnings beat. It echoes what we heard from TJX last week as shoppers flock to their stores to hunt for deals. And the big draw is that in-person treasure hunt, something difficult to disrupt from an AI standpoint. And for that reason, investors have been piling into this name. Shares were already up 8% year to date heading into the report. And we have been watching these software names closely when it comes to their earnings. And more often than not, they have disappointed investors. The latest example is GitLab. Shares are down 7% after it gave an outlook for fiscal 2027 that came in well below estimates, just adding to the AI anxiety around software. And we end on Coinbase. These shares are higher for several reasons. Shares are up 6%. Kathy Wood buying $4 million in shares. But more interestingly is this Politico report that CEO Brian Armstrong was at the White House yesterday meeting with the president, which then explains the president firing off a Truth Social, criticizing banks for stalling a crypto bill. Now at the center of this clash is whether crypto firms can offer yield on stablecoins, something banks have been lobbying hard against, warning it would pull deposits out of the traditional banking system and threaten lending. John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, Iran reportedly coming to the negotiating table. The New York Times reporting Iranian intelligence operatives approached the U.S. government over the weekend with an offer to discuss terms to end the conflict. Elsewhere, the president saying the U.S. will provide naval escorts and insurance for ships passing through the Strait of Hormuz. The president writing on Truth Social, no matter what, the United States will ensure the free flow of energy to the world. And finally, the president also threatening to cut off all of trade with Spain. His comments coming after the country denied U.S. access to its air bases during attacks over the weekend.
Some of the European nations have been helpful and some haven't. But some of the European, like Spain, has been terrible. I told Scott to cut off all dealings with Spain. So we're going to cut off all trade with Spain. We don't want anything to do with Spain.
The Spanish Prime Minister saying he won't yield to threats.
To me, the reason why this is particularly notable, aside from relations between the U.S. and Spain, is what happened in the wake of the EY-Parthenon ruling by the Supreme Court. And what President Trump and his cabinet members were saying yesterday was saying it reaffirmed his ability to use the law to take other actions, including even imposing economic embargoes. And what I view this is almost a test of how far President Trump could take this to exert the same leverage, if not even more, than what he had under EY-Parthenon, which was struck down on the Supreme Court.
I come at this from the European angle. There's something like 27 members of the EU. This is why it's so difficult to set policy at the European level, because you have a government like Italy, right-wing. You have a government like Spain, I would say super, super left-wing at this point. And Spain has a different view of developments in the Middle East, also has a very different view of developments in China as well. And if you want to talk about trade and take the Middle East out of this, foreign policy is an issue with the Spanish, and I would say trade policy is an issue with the Spanish government as well. If ultimately you want to do something about getting China to change its economic model, you can't get Europe on board right now, because there are governments like the Spanish government who are preventing you from doing that.
Right now, this is absolute fragmentation in its most obvious form. It is fragmentation for the European Union, which puts them in a spot of difficulty when it comes to negotiation. And it points to the fragmentation of U.S. policy in terms of trying to figure out where leverage comes into play. That is why, when we talk to investors, it is a feeling of macro paralysis. And I'm quoting Jim Zelter of Apollo here, but really, this is the embodiment of it, with people not even feeling like they know how to trade, what headline they're going to hit by, and what shock to focus on any given day.
12 months after the last bout of macro paralysis. Commodities in focus right now. Crude higher by 1%, 82.22. WTI 74.65. Paul Sankey of Sankey Research joins us around the table. Paul, it's good to see you.
Thanks. Hi.
Let's talk about this shock, and can we start with the president's plan? Two pillars, really, to support traffic through the Strait of Hormuz, accompanying these ships with some kind of military presence, and then insurance. For an expert like yourself, how did you respond to the details of that?
Well, I think the insurance move is obviously key, because that's what stopped the trade. And you've got the tankers absolutely within range of being attacked, but just sitting there and refusing to move until they get some sort of security. As you know, we've got 20 million barrels a day here in a 100 million barrel a day market. So you have to get this oil flowing. And I think talking to Javier Blas on Monday, it was like, this has to be resolved by Friday. Otherwise, the market's going to start panicking again. If we're not getting this stuff flowing within days, if you're talking 20 million barrels a day at walking pace globally, every day that passes, you're developing a bigger and bigger problem. So it's a major concern, and it's very interesting that the market isn't responding more. It had run up into this, but it was also retaining a very strong backwardation. So very high belief in future prices.
I'm interested in your perspective on the calendar. This is important. We get a lot of people on the programme and we'll say, what do you think? And they'll say, it depends how long it lasts. And I'll say, what does that mean? What's circled on the calendar for you that it gets real? And they'll say weeks. They'll say a month. Let's see if it lasts a month. Why are days so important to you? Just
because of the sheer volume that comes through here. I mean, you've had the Qataris voluntarily also back off LNG movement. And it's just the sheer weight of volume of everything that moves through the Straits that's so important, which makes it really a matter of days here. When you casually say this could last 4 weeks, the market's not believing that at the moment. But I mean, if we do, it's going to be a major problem. And you've got to keep in mind, as we mentioned earlier, that with the Houthis, you haven't resolved the issue around the Red Sea. So we don't have proof that we can resolve these issues when we are threatened by terrorists attacking shipping lanes. We're talking to the Saudis and hearing they can now move 7 million barrels a day through the Red Sea, but they have an uncertainty, will the tankers be able to even go through the Red Sea? So this is a crisis of shipping, and at the moment, the solutions are not obvious. You know, it's all words.
We'll get into the Houthis and the crisis in shipping, which I think is really important. I just want to follow up, though. You're saying that if we don't get a resolution by Friday, then panic sets in. What does panic look like in terms of pricing?
Well, you're already seeing it, because the release valve is the European gas price, right? So that's where you see the first action, and then the second action is in distillate. The other aspect which we've mentioned is that China, you know, is very dependent on all these flows, East Asia, and of course China has a different relationship with Iran. There's a concern that China may be backing Iran at a given point and allowing them to continue this for longer. And then we simply don't know. There's a very negative theory that Iran is actually waiting to re-release a whole nother wave of missiles, or are they actually beginning to run out of stuff to throw out there? And we just don't know whether or not they're actually running down on stockpiles or whether they're waiting for another further bigger attack. So it's a very concerning, indeed, needless to say, situation.
People are also trying to game out what kind of inflationary pop or inflationary impulse this could be if we're looking at $130 a barrel, which some people have put out there in a case of a protracted conflict. In the case of the crisis in shipping that you're talking about, which seems very likely based on the Red Sea and the Houthis and some of the fringe groups that could potentially come into play here, how much of a premium would you expect coming into the shipping lanes, coming into transport, coming into materials that hasn't been factored in yet, that is almost structural just by virtue of this threat being exogenous and persistent?
Yeah, I mean, I think structurally what you would say is that you're probably going to have to reprice growth into the U.S. production. And so you need to take oil on a sustained basis above 80 and beyond to release another level of U.S. reserves. The oil companies here are really planning on 60, 50 lower, You need to get them to plan on 80, 90, and that would take you into triple digits on the spot price before the companies believe that it's worth drill baby drilling again. So there's that on a structural level. It's actually a reversal of what we were looking at. We were looking at an oversupplied market with the need for the US to produce less. Now we're looking at a very threatened market with actually the need for the US to produce more, and companies that are very disciplined now in their capex and are reluctant to do that. So that's one structural notion. The other one is that you're already seeing, I think, significant economic damage here. Obviously, the Middle East was a major economic driver. Dubai, you had 1,000 people a day arriving in Dubai, immigrating net. A booming economy in the Middle East that obviously is going to be in disarray at this point. So you never want to get too carried away with your oil price forecasts, because obviously ultimately demand begins to react quite sharply. And we're already seeing pump prices in the UK. I've just come back from London, immediately up, by another 5-10% at the pump before really any physical impact has occurred. So these things are happening very quickly. And we'll see. It's just lucky that we're not in a particularly sensitive time for gasoline prices. We are coming out of winter. So there's a couple of mitigating factors on the demand side. But ultimately, we saw how high you can go with Russia. We got to the 125 type levels before everything just fell away. And I would say on balance, Russia was almost more of a physical shock than what we're facing here. I think they can keep the oil flowing. So I don't think that we'll surpass Russia peaks that we saw in 2022, which was already at European gas prices with a further extraordinary shock from Russia. Here, I think there was some preparation for this kind of event happening. It's just the sheer physical weight of what we're looking at coming out of the Straits of Houthi are so big that solving the problem is going to be a major challenge that needs to be solved almost immediately.
Paul, how close are we to breaching storage capacity for some of these big producers?
We did. Look at Iraq. They've had to shut down production. They just don't have the capacity to store the oil that they can't move.
Do the Saudis, they have some release valves. They have the East-West pipeline.
They do, and they're saying that's now 7 million barrels a day of capacity after Abqaiq, actually. So that's impressive. So we can take 7 million barrels a day. Going back to this Red Sea problem, we could shift to significant Saudi volumes. And, of course, Saudi are very well organised around their storage. The Iraqis don't have a lot of storage, and they've had to almost immediately shut in production. And then, of course, in all this madness, you've got the whole situation in Russia-Ukraine continuing to flame. So it's a crazy world out there, and it's a measure of the crises that we've been through that we haven't seen more price action in oil, because it's, we haven't seen a sustained rise structurally in oil prices since '74, but boy, have we seen a lot of crises in the Middle East since then. So there's a sort of market faith in the ability of the market to the oil industry to work around this, and that's pretty interesting. Again, we also had a coming glut of LNG that is sort of mitigating this. One thing I would say as well, Lisa, just on the point of demand, is that AI demand is price inelastic. So that's very interesting. These companies are going to keep spending on AI for at least 2 more years until it's demonstrably a disaster, and that means there's going to be absolutely.
That's a powerful point.
You drop that in.
That's going to be that's going to be more demand for energy, and we say that if you have an electricity crisis, if you have a shortage of electricity, it's bullish oil because your solution is distillate. And we've done some work looking at the availability of incremental distillate, for example, from U.S. refining. There really isn't any. So there's a lot of really dynamic things here that are happening that are concerning.
Paul, I've got one final question. You alluded to the shape of the curve. Can we just finish on that? Most people view this as an issue for spot and not an issue looking further out. Do you disagree with that?
Oh, I think this structurally changes a lot because the entire debate in oil had actually, the zeitgeist had shifted. As we said, you had peak oil supply concerns 2000 to 2010, 15. Then you had peak demand concerns for oil that were actually, we were going to see the rise of the Tesla and everything else. And now we've gone back to the idea of actually with AI, oil demand, according to Exxon, is going to be flat, all things equal, through 2050. How are we going to supply that much oil? And you've seen, for example, Wood Mackenzie putting out the global major oils, private major oils, need to find something like 22 million barrels a day of incremental production over the next 10 years. And it's like, I don't quite know where they're going to find another 4 or 5 Guyanas right here. So I think that, that's why the equities are actually arguably better than that, discounting the long-term oil price than the spot curve. The spot curve, as you know, the price of oil basically is heavily traded in the first 3 months, and then the rest of the curve tends to be a smear of wherever you're at. It's not strictly true because at times we've had inverted and smiley curves and everything else, but broadly speaking, all the liquidity is in the first 3 months. Historically, we've argued that the equities are a better discounter of the oil price. And I've been saying this year, for the first time in my career, I've been bullish the oil equities and actually bearish the oil price. Now, I was flat wrong on the oil price, but actually, you know, thankfully, we were pushing Schlumberger, we were pushing Exxon, we were pushing all of them more or less. And that's obviously played out. What the market seems to be telling you is that we're looking at a structurally higher oil price here long term. That's why I'm buying the equities. And the spot market is as the spot market does.
Paul Smart, great framework clinic. I expected one. It's good to see you as always. Thank you,
sir. It's a pleasure, my friend.
Paul Sankey of Sankey Research.
Again.
Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Chinese Foreign Minister Wang Yi is calling on Israel to pursue an immediate ceasefire in Iran. He spoke with his Israeli counterpart on Tuesday and said Beijing will play a constructive role in easing regional tensions. Wang also urged Israel to take steps to ensure the safety of Chinese citizens and firms. Airlines continuing to suspend flights across the Middle East due to the crisis. Tracking service Flight Radar 24 says more than 12,000 flights have been canceled since Iran's first retaliatory strike over the weekend. The U.S. State Department announcing plans yesterday to help evacuate Americans who want to leave the Middle East. And meanwhile, here stateside, the results are in from the first primary races in the 2026 midterm elections. In Texas, four-term Republican Senator John Cornyn is headed to a runoff with State's Attorney General Ken Paxton. With 88% of the ballots counted, Ken Paxton trails Senator Cornyn by 1 percentage point. The runoff election will take place in May. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, inflation getting a lift.
Prices are going to go up, and ultimately, if it persists, GDP is going to go down. Now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters, potentially.
Up next, we'll catch up with Greg Daco of EY-Parthenon from New York City. You're watching Bloomberg TV. Struggling to hold on to gains at the moment. Equity futures still positive, but off session highs. We're positive by 0.15%, up by 0.2 on the Nasdaq. Under surveillance this morning, inflation getting a lift.
Prices are going to go up, and ultimately, if it persists, GDP is going to go down. Now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters, potentially. It really is a complex situation because of this incredible risk that we might begin to see even more upside pressure on inflation from an already pretty bad starting point.
So here's the latest this morning. Effects of the conflict with Iran starting to add up. US prices for gasoline and diesel on the rise following days of higher crude prices. Greg Daco of EY-Parthenon writing, any successful strike on critical production or processing infrastructure would generate a far more significant market shock. Greg joins us now for more. Greg, good morning.
Good morning.
Is this a shock for Federal Reserve policymakers yet?
Not yet. I think what policymakers are going to want to do is wait for more data. They've been very patient. They've signaled that patient, and there is a hawkish bias amongst Fed policymakers to essentially wait for more data and see how the economy evolves, the U.S. economy evolves, how inflation evolves. And I think one key factor that we have to keep in mind is that inflation remains above the 2% target. It's that simple for Fed policymakers. As long as inflation doesn't show any credible signs of sustainably coming back towards the 2%, they're not going to be considering much additional easing from here. So the next few months are going to be on hold. And I think the current conditions likely increase the probability of this.
Well, let's get to the current conditions. Does the labour market give them the luxury of time, the luxury of waiting?
Well, I don't know. We'll have to see what we get on Friday, because I'm doubtful that the January print was a sign that labor market dynamics are improving significantly. I'm still of the view that we are in an environment where low payroll growth is going to be the new reality, where labor supply has been significantly constrained by reduced immigration, and whereas most are saying, let's not be too concerned about the labor market because the unemployment rate is still low, I am concerned about the income shock. In an environment where you see job growth close to zero and where wage growth is decelerating, and remember, wage growth is that price gauge for how tight the labor market is, that combo leads to slower income growth. And that's what you and I depend on to spend. And that explains why there's been such a dip in the saving rate, why there's been a rise in credit usage. Those are not lasting abilities to spend in this environment. And so I'm increasingly concerned about the income shock that is coming through to the economy. Add to that a potential shock from inflation, and you have a mix that is somewhat concerning for the outlook for consumers.
I'm so glad you said this, because typically oil spikes are both inflationary in the short term and disinflationary over the long term because of the dampening effect of the spending power of so many people. I'm interested that the market is taking this simply as an inflationary shock. You're not seeing that disinflationary aspect of it come into play, and the market is treating the Fed as though it's going to do the same. Do you think that that's correct?
I think we have to consider the affordability constraint as a reason to essentially be careful as to what the factors are influencing affordability. Yes, prices, of course, are the key fundamental factor affecting affordability, but the income lever is very important. If you have sufficient income to essentially withstand any price increases, then you're fine. You're still going to be spending. You're still going to see different actors in the economy, businesses and consumers, hiring, spending, investing. But if that constraint becomes too high for income to continue to grow in real terms, then that's where you start to see a pullback, and that's where that starts to become a key constraint for Fed policymakers. We have to remember one thing, Lisa, is that in this environment, we're seeing an increasing number of supply shocks, and most policymakers are not equipped to deal with supply shocks. Over the past few decades, it was all about trending along potential with demand shocks around that. This environment is all about supply shocks, which tend to be stagflationary. Whether it's trade and tariffs, immigration, or oil price shocks, they're all supply shocks.
This was the common knowledge a couple of years ago, but then AI happened, and AI spending seems to be price indifferent. It seems to be inelastic in any way. Buy at all costs, invest at all costs. It feels like an existential threat not to be ahead in the AI race. I just wonder, if you get this dynamic where you have prices that are increasing, you've got people with wages able to pay for it because they're the haves, you have other people who aren't, is the Fed going to err on the side of being hawkish because of 21 and 22?
I think so. I think the Fed does not want to be burned in terms of the inflation dynamics. A number of policymakers have continued to refer back to the 21-22 period where they were a little bit late to react to the price shock that was coming from the post-COVID recovery, and then the energy price spike that we saw after the onset of the war in Ukraine. I think most policymakers in this instance, while the textbook would tell them to essentially look through a transitory oil price spike and natural gas price spike, they're likely to be more cautious in resuming any easing because they've been burned in the past. And it's as simple as the fact that inflation is above that 2% target, and they're not going to want to provide any perceived accommodation and risk being seen as being on the wrong side when it comes to policymaking.
Leadership matters, often forgotten, but we were waiting to see if Chairman Powell got a second term. And here we are waiting to see if we can get confirmation of Kevin Walsh. We're kind of in limbo right now at the top of the Federal Reserve.
And waiting to see whether Fed Chair Jay Powell is going to stay on, because Minneapolis Fed President Neil Kashkari is saying he'd love to see that.
Hey, Greg, it's good to see you. Thanks for
Always
dropping by.
a pleasure.
Great work last week, by the way, with Madame Lagarde. It's good to see you. Thank you, sir. Greg Daco there of EY-Parthenon. In the next hour of Bloomberg Surveillance, Chris Harvey of CIBC, Tobin of Wolfe Research, Jim Bianco of Bianco Research, Tom Tzitzouris of Strategas. From New York City, you're watching Bloomberg TV.
Energy is the leadership. That's where we are right here.
Most of the price action is because of the traffic in the Strait of Hormuz being halted.
The math is pretty awful for oil and gas if it remains closed.
Oil prices continue to rise. Then all of a sudden you have a stronger inflation impact.
The long-term impact of this, which will take weeks and months to clear out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Positive by 0.1% on the S&P 500. On the Nasdaq, up by 0.25. On the Russell, up by 0.4. In the commodity market, off the highs of the last 24 hours. The high of the last 24 hours ago, $85 a barrel, $82.60 so far this morning, up by 1.5%. The president offering very vague details of a plan to support traffic through the Strait of Hormuz. That's one pillar of support. Here's another. About an hour ago, this from the New York Times. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. That, according to officials briefed on the outreach.
This feels like the market is super hungry, and it is jumping on anything that looks vaguely like food. In this case, they're looking for an off-ramp, and this provided some sense that there could be a resolution that lasts less time than, say, 4 or 5 weeks, which seems to be the danger zone that a lot of people have talked about, other than Paul Sankey. Look, I think it shows where the bias of markets are and what the market is hoping for, and I hate to personify the market, but it highlights how offsides this market would be, Mr. Market would be, should this continue for a while.
Well, let's take that a few steps further. It depends who you're talking about in the market right now. And this isn't a judgment on one asset class or the other, just to show that we're observing different views in each. In equities, there is this sort of playbook, this bias to fade this risk. In commodities, it's a very different story. And I think we heard that from Paul Sankey of Sankey Research just moments ago, and we've heard it from Jeffrey Curry of Carlyle as well. There is a view in the commodity market that this is far more serious than some market participants are taking it. And you shouldn't fade this. This is not just about the next few days. This is about something much bigger over the longer term.
And if you take that a step further to the bond market, it highlights why people are worried about inflation suddenly, and they're worried about the Fed not necessarily responding to it by just standing pat and looking past it. There is a structural increase in cost to shipped goods, akin to what Jeff Curry was talking about, tied to some of the geopolitical threats that are very real. We have seen them time and time again and are going to take time to work through. And Paul Sankey was talking about that, the stockpiles, just the glut of oil and natural gas that needs to move, that's getting stockpiled up, that isn't getting produced. That's going to take time to put back on the seas, and that's going to be something that's going to be baked into prices.
We hope we can get that traffic moving again through the Strait of Hormuz. We hope that can take place. And we hope there is an off-ramp here that can lead to a de-escalation and a backing away of hostilities between all of these sides right now. But when you look at the reality and read headlines like this, and I mentioned this in the last hour, the UAE saying they intercepted 3 missiles already today and 129 drones. And you're seeing that beyond the UAE and across the Gulf.
I thought Jumana Bersachi did a great job, our correspondent in the region, talking about how much more the volume of missiles from Iran have been going towards some of their former allies, their erstwhile allies and partners in the region. There are other Middle Eastern nations, even than Israel during the 12-day war. It just highlights how it's just attack everyone and how a lot of people feel incredibly vulnerable right now.
Live from New York City this morning. Good morning to all. If you're just tuning in, equities are doing okay, positive by about 0.2%. Coming up this hour, great lineup for you. Chris Harvey of CIBC joins us as markets wake up to macro risk. Tobin of Wolfe Research on the effort to reopen the Strait of Hormuz. And Jim Bianco of Bianco Research as rising crude prices fan global inflation fears. We begin this hour with stocks inching higher following another very volatile session. Chris Harvey of CIBC writing the market reprice risk into the Iranian military conflict. The resolution is unclear. We think it now effectively represents the macro risk. Chris joins us now for more. Chris, good morning.
Good morning.
Start of the year, you said this market was sleeping on a lot of macro risk.
That's right.
We're still about 2% from all-time highs. Have we at least woken up now?
We've definitely woken up, right? So my issue coming into the year is risk was mispriced. Your risk aversion assets were unloved and underappreciated. They've been derated all in 25. Everyone was on one side of the boat. Everyone's really, really positive, really, really constructive. And we just thought people are sleeping on tons of things, right? Whether it was a Fed transition, Fed being super positive, whether it was management of earnings. We didn't call for some of the geopolitical risks that we're seeing, but we expected it to start to increase. And so we thought you really needed to reprice risk. You have, and that's one of the reasons why I think we haven't seen this major move in and around the conflict.
3 sources of risk now.
Right.
So we go through them piece by piece. One, of course, is the AI disruption.
Yep.
2 is the credit jitters, and 3 is this shock over the weekend. Are you worried about one more than the other, or just the accumulation of all the events?
I'm really more worried about it. So I do think, again, with a conflict, anything can happen. So it's a wild card, but it does look like it's going to be shorter in duration. We'll see how it plays out. I think the credit issue is a bigger issue. It's going to linger for some period of time, and it'll flare up. I don't think it's going away. And one of the things that we just saw is that what happened in the equity market is happening in the credit market. We needed a repricing of risk in equities. Now we're seeing a repricing of risk in credit. IG credit got down to 71 basis points, which was a generational low. Now we're up to 84-ish, right? That's not bad. They're still very, very low versus history, but you need to reprice that. Some of the issues, I think there are people that are offsides, that got too aggressive, maybe applied too much leverage in certain situations. It's more idiosyncratic at this point in time, but I think that's the gift that's going to keep giving, and that's something we're going to have to watch, especially if the economy slows down in 2026 or later this year.
And just to build on a point that John was making earlier, if you add some of the oil shock to the concerns in the credit market, how much does that accelerate the fallout if you do get a Fed, say, that remains offsides and doesn't necessarily cut rates anytime soon?
Yeah, I don't. The oil shock is not a big deal to us at this point in time. You really need for oil to go higher and be substantially higher for some period of time, right? What we need for credit is we need the economy to slow down. And it doesn't look like the economy is going to slow down in 2026. If anything, I think we're going to accelerate. It's more of a late 26 issue, 27 issue. Because the thing about leverage, it only bites when the economy slows down, when growth slows down, and then you can't pay your bills. Right here, yeah, there's some bumps in the road, and oil's going to have to be an issue, but I don't think it's a major issue. It's not, at this point, a systemic issue.
Do you think that the credit issues are going to become systemic at some point? I mean, this is something that a lot of people have been grappling with, saying a lot of it is just a rotation out of software names and trying to grapple with AI-related disruption.
Yeah, so the easy answer to that is that they'll always become a systemic issue, right? We have credit cycles, right? But what we're seeing, and what I think we're seeing, is just a repricing of this. We're seeing more idiosyncratic risk. We're seeing where people were too aggressive, and we're seeing a shakeout. I don't think when I look at IG credit, when I look at the high yield market, I'm not so worried. The markets are functioning well. They're providing liquidity. Liquidity needs to go where credit needs to go where it's getting to where it needs to go. Sorry about that. But I don't see something systemic at this point in time. It's a concern. It's an issue. It's going to cause volatility. As we get later in the year, as we see more M&A activity, the systemic risk will go higher. At the end of the year, yeah, it's something we're going to think about real hard, and something I think we're going to see.
The end of a credit cycle and systemic risk don't necessarily have to be in the same bucket.
No.
You can have the end of the credit cycle without systemic risk, and it's intriguing to me that people at our Bloomberg Invest conference right now are talking about the end of the credit cycle, and yet the equity market is 2% away from all-time highs. Does one match the other right now?
So usually the end of a credit cycle is the end of a market, right? Because what happens is the funding markets, what you're doing is the funding markets provide the liquidity for buybacks, for property, plant, and equipment, for M&A activity, and for Main Street. And when you can't get that, the gears start to grind tighter. Now, if we're talking about, hey, it's the end of the credit cycle and spreads are as low as they're going to get, and we're going to widen out, and we need more compensation, okay, yeah, then things can still work. And I think if that's what you're implying, yeah, I think equities can still work. And that's our view, is that what you need is a little bit more compensation. You need a repricing of risk. We're getting that, but the systemic risk is just not high enough to have the wheels fall off the cart.
Mark Rowan was pretty clear yesterday. If you missed that conversation with John Micklethwaite, take a listen to this quote. This will be a shakeout. I don't think it's going to be short-term. If 30% of your portfolio is in one industry and that one industry is being impacted by technology, you've not been a good risk manager.
This, to me, highlights exactly what you're talking about. Most of the people in Wall Street are expecting some sort of shakeout at a credit cycle that doesn't necessarily bring some sort of huge downfall, but actually gives them the opportunity to distinguish themselves from other different players. It's a reason why you're seeing the Apollos of the world and the JPMorgans of the world talk about the shakeout and say, look, we'll be the ones that are still standing, so watch out.
Did you see how they met redemptions at Blackstone?
They personally put it up themselves, $150 million.
Imagine that situation.
25 partners.
The executive team goes around the partners and they say, by the way, we're going to have a whip around, okay?
With a hat.
And you're thinking severe, serious credit risk that if you don't contribute,
right.
And you've got to figure out what's the right number. So maybe you call your partner and you try and work this out, right? What is it, 5, 10, 15 million? The league that these guys are in compared to everyday people. The whip around, like for us in the newsroom.
For like $150.
Can we raise like $20 to buy the cookies?
100%.
Okay, like the boss is selling the cookies and you want to make sure you buy some just so you're in good favour at the end of the year when you get that eval.
Yeah.
This is like that on steroids.
This is unbelievable.
You've got to come up with what? Like $150 million.
$150 million from 25 partners. I was actually thinking the same thing. Were they taking a hat and bringing it around the office? Can you spare a couple $20 million?
You've got ambition to be the next John Gray.
I mean,
or Steve Schwartzman.
You have no choice.
You're like, okay, like,
sure,
yeah,
here.
I guess I can give you 20.
Down payment for my future career.
Chris, do you want to weigh in?
I'm good here.
Chris, it's good to see you.
It's a pleasure.
Chris Harvey of CIBC. Just imagine what that was like. I'd love the details of that.
I actually was thinking the exact same thing when I was reading that. I mean, how forced did people feel to do this? What were the conversations like with their wives or significant others? Do they have to go home and say, you know, look, I'm sorry, but we're going to cancel vacations? Do they actually have to cancel vacations, or is it nothing for them?
Are you telling me that doesn't count towards your compensation by the time you get to year end? Like when I'm setting the bonus pool for you, Bramo only gave us $2 million, you know, so-and-so gave us 10.
Oh, you think that there's sort of a return on capital for the bonus pool?
Seriously?
Well, I actually think that there must be some sort of loan structure. That's what I was wondering.
I'd hope so.
I was actually thinking this is probably, they contributed from their paychecks,
right.
But there might be some sort of loan structure where they were getting some sort of lockup in the fund for a longer period of time. That's what I was thinking.
I'd also love to know, if you're the one guy that didn't put any money in the hat,
He's
reach
not there
out.
anymore.
I'd like to find
just left.
That one person.
He just left the firm.
Absolutely
Sorry.
not.
He's looking for a new job. We need a producer. Come on over.
Let's get you an update on stories elsewhere this morning. We can't afford them. Let's get you a Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Just recapping that outrageous story you guys were just talking about. Blackstone's senior staff opening up their wallets to help weather withdrawals from its flagship private credit fund. According to sources, more than 25 senior leaders from across the firm putting forward approximately $150 million to the Blackstone Private Credit Fund, combined with $250 million of the firm's own capital to cover a record redemption request. Meanwhile, the South Korean Kospi suffering its worst one-day sell-off on record, plunging 12% in today's trading, following a 7% drop on Tuesday. The index seeing an AI-driven rally this year that sent it higher by more than 20%, while the S&P has turned lower on the year, currently down by about 0.4%. And Pakistan saying it's in no hurry to end its military operation in Afghanistan. A senior Pakistani security official says the duration of the operation depends on actions on the ground by Afghanistan's Taliban government in rooting out militant groups. Dozens of people have been killed since the Taliban launched retaliatory attacks last week against Pakistan's airstrikes on militant targets. That's from a brief. John?
Hey, Yahira, I appreciate the update. Thank you. Up next on the program, looking for an off-ramp.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
That conversation up next with Tobin of Wolfe Research, live from New York City this morning. Good morning. I'd just like to reiterate a programming note. In about 45 minutes' time, we will catch up with the U.S. Secretary of Defense Pete Hegseth alongside the chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon at 8 a.m. Eastern Time. Looking for further details of this conflict. We'll bring you some of that a little bit later this morning. Again, 8 a.m. Eastern Time, 45 minutes away. Equity futures at the moment on the S&P 500 positive by 0.2%. On the Nasdaq up by 0.3. On the Russell up by 0.5. Holding on to gains in the commodity market off session highs for crude. We're only higher now by about 0.75% on Brent, and you're seeing us turn lower on WTI. 74.32. We're down 1/3%.
You have two prongs here. First, it does seem like there might be some sort of off-ramp, as indicated by that New York Times story, talking fourth person. There also is the potential for the U.S. to do something in the Straits of Hormuz to try to accompany ships. Either way, people are looking for some sort of Trump put, and they're hoping that will happen, at least in U.S. pricing.
Under Savannah's this morning, looking for that off-ramp.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible.
So here's the latest this morning. Crude pairing early again after reports suggesting Iranian operatives have reached out to discuss ending the conflict. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Let's get back to that piece from the New York Times. Just go through the details and tell us what stood out for you.
Yeah, hey, John, good morning. Well, the New York Times is reporting that a day after the attack this weekend, operatives from Iran's intelligence agency reached out to the CIA through another country's spy agency. Still, U.S. officials reportedly remain skeptical that either the Trump administration or Iran is really ready for a diplomatic off-ramp here. As the story notes, President Trump had noted over the weekend that he would be open to negotiating with Iran's transitory leadership team. But then just yesterday, in a post on Truth Social, he said that it was, quote, too late. Now, I will point out that Oman's foreign ministry on Sunday, a day after the military campaign started, did post on X saying that Iran was interested in, quote, serious efforts aimed at de-escalation. But then we heard from Iran's security chief batting down that report publicly. So at this point, a lot of this is going to come down to questions about what the future of Iran's leadership looks like. And I was in the Oval Office yesterday where President Trump said that the potential worst case scenario would be if new leadership in Iran emerged, quote, just as bad as the current regime that the U.S. and Israel are trying to change. And while President Trump has previously advocated for Iranians taking over their government, President Trump said yesterday that the U.S. is hoping that a more moderate leader would emerge that the administration feels that it could work with for a potential solution down the road. But then he noted that a lot of the contenders the White House had been tracking have been killed in airstrikes. John, one thing is clear. At the minimum, the U.S. has telegraphed that there needs to be a lot of issues on the table in any potential agreement, including an ending to Iran's nuclear program, an ending to its ballistic missile program, and a stopping in its support for those proxy militia groups in the region.
Tyler Kendall with the latest down in Washington. Tyler, thank you. There's a big question, an outstanding one. To what extent is this administration sensitive to market developments? 12 months ago, there was a feeling that they were very sensitive to market developments, particularly in the bond market. And then you see a headline like this from the Treasury Secretary, speaking to the American press just moments ago, that the 15% global tariff rate is likely to start this week. So if there is concern, it's not that great.
I think that's a really important connection here, that how great is the President Trump put if you do see them reiterating some of the tariff increases that they had talked about before at a time of heightened geopolitical risk and already a risk-off feel in markets. Just to extend this, again, yesterday, some of the tensions between Spain and the U.S., you heard about some of the other powers that they could start to deploy, trade embargoes, things of that nature to get the leverage back from IEEPA. So is this going to be reflected only if the markets allow it? Well, I don't know what the signal really shows.
Let's build on that conversation. Tobin Marcus of Wolfe Research has this to say. If either economic or political costs start to pile up, Trump can look for the exits, either through negotiations or simply through unilateral withdrawal. Tobin joins us now for more. Tobin, let's get to that point, the pressure point. How close are we to it?
I don't think we're that close. I do think that President Trump feels that the military campaign is going well so far. One of the notable developments in the early innings of the war has been Iran obviously is trying very aggressively to strike some of these energy targets, regional, refineries and oil export terminals. They've, successfully threatened the strait, although not really hit a lot of ships. But if we start to see, as many people have worried about, dwindling interceptor stockpiles, those attacks starting to get more successful, our point is Trump has a lot of optionality here. The way that the objectives of this war have been defined, where it's not about regime change, it's about doing enough damage to Iran's missile and drone program. And that question about what is enough is entirely a judgment call that's up to the president. So I do think he has a lot of optionality about when and on what conditions to start to wind things down.
Tobin, there's a real question around what pushes him to want to engage with that optionality. Is it market movements? Has the oil market gotten to a place where it could potentially be raising some red alarms as you see the price at the pump increase? I mean, is there a pain point that you're focusing on?
Yeah, and I think we could get there. I certainly don't think we're there yet. He's sustained, if we're at triple-digit oil prices for, weeks or months, obviously that starts to get a lot more painful than what we've seen now. Those are scenarios that a lot of people have modeled and speculated about. And if that plays out, I think that starts to be a situation where the president would look to get out. Similarly, if we see really alarming, movements in bond markets and currencies, obviously yields have backed up a lot over the past two sessions, but they're not at an alarming level. So you can imagine that sort of reaching an alarming place too. Again, I don't think that we are there yet. I can't, give you a number on the Trump put. But I will say also, if you think about the rhetoric and compare back to how he was talking before and immediately after Liberation Day, there was a lot of talk back then also about, it's going to be this period of temporary pain. If we have some pain, it's going to be okay. They're sort of indicating that they were willing to weather the storm in the same way that he was saying yesterday in the Oval Office, we might have this period of elevated oil prices, but it's not going to be that bad. But nevertheless, when things did get bad, they changed course, despite what the rhetoric had been in advance. And I think that's probably still true.
How much is the Republican Congress a check on this? The idea that maybe there could be some pushback. This isn't very popular in terms of people supporting the effort in Iran. I'm just wondering, from your perspective, do you see that as potentially causing a bit of a halt to this?
Yeah, I don't think they're particularly concerned about what they hear from Congress, even on the Republican side. For the most part, congressional Republicans have been pretty supportive. And when you look at the polling, first, as we expected, the approval of the war has gone up as the war has, gone relatively well in the early innings. It's very heavily polarized. But among Republicans, support's very high. I think 85% of Republicans say they support the war. They're underwater among independents. They're very underwater among Democrats. It's not by any means a political winner. But I think in terms of their base and what he's hearing from political allies, that's not where the unpopularity is sitting.
Tobin, just getting some news crossing the Bloomberg terminal. Just want to share it with the audience. This from the UK Maritime Agency saying that a container ship was hit while transiting the Strait of Hormuz, struck by an unknown projectile. No more details on that other than that. Put that together with a headline that I saw earlier on this morning, and I've shared with the audience a few times, about the amount of projectiles going into the UAE, that they've already intercepted 3 missiles and 129 drones at last count today. Tobin, when you see headlines like that, and then you get excited about the prospect of an off-ramp because there was some outreach over the weekend, how excited should people be about the prospect of an off-ramp, Tobin? And I'll share this story again with our audience from the New York Times. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. Should we be encouraged by the fact there was outreach, or discouraged by the fact that the administration ignored it?
Yeah, and I think on the Iranian side, I think there is some fragmentation as the transition away from Supreme Leader Khamenei continues. So, even if some elements within the government are reaching out, I don't think that necessarily means that everyone's ready to hang it up. Their explicit messaging from figures like Larijani has been more, more that they're in it to win it, and they're prepared to tolerate some pain and weather a longer period of war. I do think that the decision is probably going to come from President Trump's side, and it's going to come as a judgment call about when enough is enough. I don't think that the offers that the Iranians are going to be able to make are going to be satisfying in the same way that the negotiations seemed kind of doomed heading into the conflict. I think what it is that we want from them are going to be really tough concessions for the regime to make. And so my guess would be that it's more a question of doing enough damage that we feel like we've degraded the missile program to the point that we want it, or absorbing enough costs that it no longer feels worth continuing.
It's good to see you, Tobin. As always, Tobin Marcus there of Wolfe Research on the pressure points for the administration right now. Look, with regards to the outreach, clearly there's a lack of trust between the two partners, and that's why talks broke down 1 and 2. Is Iran in a position to really follow through on any kind of off-ramp, even if there was an agreement, given the lack of leadership in that country right now?
Who are we talking about when we say Iran?
Precisely.
I mean, who are they even negotiating with, and is that person still around? Coming up on the programme, we'll catch up with Jim Bianco of Bianco Research as Fed officials debate the threat of higher inflation. Plus, Yahira has your morning movers. Shares of Micron and SanDisk rising on memory demand. Those two names gaining in the pre-market. From New York, you're watching Bloomberg TV. It's difficult to keep up with this market, so let's do our best. So equities were firmer. Now they're down about 0.1% on the S&P, turning lower on the Nasdaq just moments ago. Moments ago, we heard from the Treasury Secretary, Scott Bessent, speaking to the American media a little bit earlier this morning, saying the 15% global tariff rate is likely to start this week. That's weighed on equities just a touch. Supporting equities just a bit was the report of outreach from the Iranian side over the weekend. That report coming from the New York Times. And maybe some increased sensitivity from the administration around the energy story, providing a framework to help traffic navigate the Strait of Hormuz and maybe a mechanism to ensure some of those ships. Now, that all sounds great. The details, though, were pretty vague, Lisa.
And a lot of people are very skeptical that kind of thing can be put in place anytime soon.
Is this a tradable market? I mean, I'm asking seriously, given the fact that we're being whipsawed by headlines, and I understand that the moves aren't massive, nonetheless, one of these different scenarios could cause a completely different outcome, and the tail risks are getting so significant. You're talking about potential off-ramps, maybe. You're talking about potential escalation, re-escalation with the trade war now, and then you're talking about what does a conclusion to a conflict look like that could get some of the prices of oil and shipping back down to where they were before.
It's a resilient market. Think about everything we've thrown at it. This shock over the weekend, AI disruption, massive moves beneath the surface, credit jitters as well. We've had credit spreads start to widen. Not blow out, but start to widen. And yet we're around 2% away from all-time highs on the S&P 500.
People do not believe there will be a recession. People believe in the resilience in the U.S. economy and say, typically you fade geopolitical risks. That's a knee-jerk reaction right now. That's what people want to believe. And the fundamentals seem to suggest that. But when do you keep paying attention to the fundamentals when they're overcome by events?
If I tell the Treasury Secretary at the start of the year that you can have a bond market close to 4% on 10s, they'd take that, right?
Totally.
4.1%-ish. Right now on 10s, I think the administration would take that.
Yeah, of course, we are freaking out. Does this mean a reinflationary boom? Are we too complacent about some sort of potential inflationary shock? Look, this is not exactly a volatile market on a headline figure. Under the surface, it has been whipsawed, nosebleed, people being blown out of momentum positions, and that's the reason why I think a lot of people are feeling quite different than that.
Let's finish on commodities. So $85 a barrel yesterday, very briefly. We backed away from those levels. We backed away yesterday afternoon off the back of the president's plan, if we can call it that. 82.32 right now this morning, higher by about 1%. WTI kind of inching higher as well. It's the commodity guides that concern me right now, and I keep going back to this point. A lot of other people in markets, and this again is purely an observation, it's not a judgment about who's right or wrong, but a lot of people in equity markets are making the case, look at the geopolitical playbook, typically you fade it by the dip. But the commodity guys are very concerned about a real material spike from here to maybe triple digits, because they believe we're very, very close, days and not weeks away, from needing to shut in production because we're breaching storage capacity. That's a story that might be just on the horizon.
We've already seen that. It's actually a story in play in Iraq. Question of how long before it starts to be in play in places like Saudi Arabia that does have an off-ramp, but the UAE, as well as, of course, Yemen and others. This is a real question that people are trying to examine as they look at the forward curve and they look at where the price should really end up.
Crude right now, 82.40 on Brent, 74.80 on WTI. As we count you down to the opening bout, 2 hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing shares of SanDisk and Micron bouncing back this morning after falling sharply yesterday, each down about 8%. The two memory chip names, as we know, have been some of the market's biggest winners, but were caught up in yesterday's risk-off mood. But now you have the dip buyers coming in because the situation has not changed. Memory chip demand is still through the roof due to the AI build-out. And it speaks to headlines like this one. We are seeing Nebius shares higher after the AI cloud company won the green light from a city in Missouri to build a giant AI factory campus. The facility could deliver up to 1.2 gigawatts of computing capacity, putting it among the biggest AI data centers being built today. So there's those shares up 2%. And we end on Bath & Body Works. This is the retailer that sells fragrance products. Sales came in better than expected as the company says it will exit areas that are not part of its core product lineup, like hair care. This is another one like Ross Stores that's benefiting from this in-store treasure hunt, hard to disrupt by AI. So shares had already run up 8% this year. Heading into the reports, up another 4.7% today. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, President Trump warning that any potential new leadership in Iran could be equally troubling.
I guess the worst case would be we do this and then somebody takes over who's as bad as the previous person, right? That could happen. We don't want that to happen. It would probably be the worst. You go through this and then in 5 years you realize you put somebody in who was no better.
Iranian officials suggesting a new leader could be named as soon as today. Elsewhere, the US offering naval escorts and insurance guarantees to keep trade flowing through the Strait of Hormuz. The president vowing to ensure safe passage of oil from the Middle East as the conflict in Iran enters its 5th day. And finally, big tech titans meeting at the White House today, signing a pledge to absorb the rising energy costs of AI data centers. Representatives from Amazon, Meta, Microsoft and Alphabet among those set to attend.
You know who else is set to attend? XAI. OpenAI. Guess who's not? Anthropic. I think it's going to be really interesting. Is this going to really be about energy picking up them?
They're out in the cold right now, aren't they?
They are out in the cold with the White House. They're out in the very warm room when it comes to a lot of the downloads.
They're up in the download charts on Apple.
Which raises a question about Sam Altman and what that relationship's going to be like, given the fact that he's trying to beg forgiveness now with his clients.
These tech guys don't help the energy problem. And we were talking about what Paul Sankey of Sankey Research said a little bit earlier. Their demand for data centers is energy price inelastic. What happens to the price of energy is not going to dictate their determination to spend this money over the next 12 months and maybe beyond. That's a problem for the administration.
Will the administration conflate some of the questions around oil prices and the shock in the Middle East with this demand from energy from AI and say, look, they're paying for our power. They can pay for the power that can offset some of this as well. I mean, this could get really interesting given how much of a focus energy is right now.
It's interesting how real it's got and how quickly it's got real.
Yeah.
This meeting is taking place. This was on the fringes last year of becoming a problem over the next several years. It was a problem immediately, and they need to react to it right now. And we said repeatedly that this is going to be an issue going into the midterm elections, that your support of tech players spending all this money, you've got to help the electorate understand why it helps them. Show me the jobs it's creating. Why are my bills higher and my anxiety around the labour market is equally as high? Because of what's being spent here. You need to show me the benefits, otherwise you'll get the pushback big time.
That's the political story. From the market story, it raises a question of how long AI can keep departing from the rest of the index, with people looking at this as a growth sector. Increasingly, if big tech companies are forced to absorb the costs of the energy that they use, at what point do they start being treated a bit more like utilities, given the hyper-regulation that will also come around this? And that will incur a very different valuation structure than what they currently are looking at.
Look out for that meeting a little bit later. Let's get to the Federal Reserve grappling with global inflation fears as the conflict in Iran threatens crude supply. The Minneapolis Fed President Neil Kashkari is saying it's too soon to know the full impact.
The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. Core goods inflation has been trending up because of tariffs. Now, with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. Right now, it's just too soon to know what imprint this has on inflation and for how long.
Jim Bianco of Bianco Research writing, if you want the Fed to cut rates, things just got a lot more complicated if energy pushes headline CPI to a big number later this month. Jim joins us now for more. Jim, do you think we're on track for that?
We very well could be. The price of gasoline, the national average, is up 20 cents in just the last 2 days. That's the biggest two-day jump in 21 years. And that alone, if we hold those prices through the end of the month, would add about 2 or 3 tenths to headline CPI. So everything is looking north right now on the inflation numbers. And that's going to make it very difficult for a Fed that's focused on inflation to say, oh, ignore all those big inflation numbers. We got to keep talking about cutting rates.
They will be conditioned by recent years. Do you think they should be conditioned by what happened a few years ago?
Yeah, I think that they should be, especially, too, if we were to get a little bit nuanced. The Fed prefers a measure called personal consumption expenditure, or PCE, and that number is actually going north. And the core PCE number in January, when it comes out next week, is expected to be 3.1%. The core CPI number that everybody else looks at is 2.5. That is unusual to see that PCE number way above the CPI number. Now, I think the reason is because OER, owner's equivalent rent, has been coming down a lot. That's been depressing the CPI number. The reason I bring that up is Fed officials are focused on that PCE number. So you heard with Neil Kashkari, when they talk about inflation, they're looking at that PCE number going up, and they're getting very concerned. And now we've got this energy thing. So they're really concerned about inflation, where maybe the rest of us are looking at CPI and being not so concerned.
Initially, the knee-jerk reaction to the war in Iran was the buying of the bonds, right? I mean, this was sort of a knee-jerk reaction, go into safe havens, and U.S. Treasuries were that haven. Then they started to sell off in the face of what you're talking about, a potential inflationary threat. I'm just wondering, from your perspective, how far this could go in terms of a sell-off before some of the concerns about disinflation, disruption, et cetera, brings down some of those yields?
Oh, I think it could go a lot further. It all really depends on, you guys were talking about this earlier. It depends on what happens next. If this war does not produce much more oil infrastructure damage and the price of oil doesn't go much higher, I think bonds could sell off some more. But we're at the mercy of headlines at any moment that there can possibly be more oil infrastructure damage that would elevate the price of oil even more. So we're just kind of waiting on circumstances right now to see where we go. But short of that, if all we're talking about is shipping disruption, no ships have been damaged. That could restart at any moment. I think that the price of oil could settle down and then bond yields could start back up. Remember, they were 220, 420, 430 just a couple of weeks ago.
John mentioned this earlier, and I keep thinking about it. If you do have a Fed that's on hold for a longer period of time as a result of this disruption, and you already have credit stress that's starting to emerge in certain pockets, does this accelerate that shakeout process?
I think it does, because keep in mind, the business development companies or the BDCs and a lot of these they're highly levered companies, and they're very dependent on interest rates. They need lower interest rates to lower their financing costs. And if we start seeing interest rates start meandering higher, and I'll use that word meandering to talk about the way that they're going to go, it's just going to put more stress on them. And the shakeout could be even more severe than just worrying about whether or not software companies still have their moat in the world of AI.
Jim, what do you make of how different companies in private credit have dealt with these problems independently? Blue Owl came out and sold a pool of loans, a portfolio of loans. They had some big buyers, some big pension funds, but also their own insurer. Questions asked about that. Blackstone doing the whip around and coming up with $150 million internally. That looks like they got skin in the game. Maybe you take some confidence from that. Jim, is there a better approach that you're seeing from certain players?
Well, Blue Owl also put some skin in the game, too, so let's not discount that as well. But you're right. They're all kind of scrambling around to try and figure this out. But I would say in the bigger picture, everybody goes to 11 when we start talking about gating with private funds. Since 2009, we've seen this after 2009 with Citadel. We saw this with after Brexit with the property funds in London. We saw this in 2020 with COVID. We saw this with Blackstone's real estate fund in 22. There's been over 100 private equity funds and private credit funds that have gated at one time or another in the last 15 years, and none of them produced a systemic crisis. They produced problems for those funds and problems for those investors. But if you weren't in those funds or you weren't an investor, it didn't produce a problem for you. And I think that we'd have to start thinking about whether or not this is different than all those other examples. And I'm kind of in the camp that it's not. It's a problem for private credit. It's a problem for those investors, but I'm not sure it's necessarily a systemic problem.
So let's stay on gating, Jim. And just a final question. I forget who said this in the last 24 hours, but I think it's an interesting one. Do you think gating is a feature or a bug of that industry?
It's a feature, and it's a feature because you're investing in a private fund that is priced once a quarter. It's not liquid assets. The private credit fund or the private equity fund comes up with the values that they will let you in or out of, and that they're not like an ETF. They're not at the mercy of a market that they can let anybody out at any time whenever they want. And so if there's too much of a demand to get out, gating is part of the feature. And as a matter of fact, you heard Mark Rowan say that yesterday. Look, if you want higher returns and you want higher returns because you like these private credit funds, you got to take more risk. And the risk might be gating.
Jim, it's good to see you. Thank you, sir. Jim Bianco there of Bianco Research. The risks accumulating. And we talked about the three key sources of risk right now. AI disruption, 1. The issues with credit, 2. And now this over the weekend and into this week, 3.
Yeah, and they're coming at the same time, which is different, right? I mean, we have seen this sort of rolling crisis in different sectors that are attacking the market, but they're not all at once. This potentially, with the meeting of tech titans in the White House with questions about credit funds, can you spare $6 million? And then this question about how long this conflict could go on. It's becoming a little bit more heady for a lot of investors.
We'll focus on the third source of risk in about 15 minutes' time. We'll hear from the U.S. Secretary of Defense, Pete Hegseth, alongside, once again, the Chairman of the Joint Chief of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon. That briefing about 16 minutes away. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Treasury Secretary Scott Bessent saying moments ago President Trump's new 15% global tariff rate will likely take effect this week. The new rate was announced after the Supreme Court ruled against the president's existing tariffs. Bessent also weighing in on the conflict in the Middle East, saying global oil markets are well supplied and the U.S. will reach out to ship owners in the Persian Gulf. In Iran, the funeral for the late Supreme Leader Ali Khamenei has reportedly been postponed. Semi-official Tasnim news agency citing the unprecedented presence of mourners as the reason. The ceremony was originally scheduled to begin today at 10 p.m. local time in Tehran and set to last for 3 days. And airlines around the world continuing to suspend flights across the Middle East. Tracking service Flight Radar 24 says more than 12,000 flights have been canceled since Iran's first retaliatory strike over the weekend. The UAE says it's starting to establish what it calls safe air corridors that will allow for as many as 48 flights an hour. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara about 30 minutes away. Up next on the programme, ignoring the obvious.
We're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious.
Tom Tzitzouris of Strategas joins us next, live from New York City. You're watching Bloomberg Surveillance. Great stats from the team over at Charles Schwab, Kevin Gordon, Lizanne Saunders. Kevin sent this over just a moment ago, just to build on your comments about that index level resilience. The S&P 500's max drawdown this year, negative 3%. The average S&P 500 members max drawdown this year, negative 12%.
The surface of the market feels pretty calm. People talk about the paddling duck type of market. I'm just struck by the fact that that is not how people feel in this market. They feel whipsawed, they feel frustrated, they feel beside themselves, and frankly deceived because the trends that they focus on change in a dime.
We keep going back to this, the longest first quarter ever. Still a month to go.
Please.
It's amazing. It really is. Still a month to go. Equity futures on the S&P 500 just about negative, almost unchanged on the Nasdaq 100. Under surveillance this morning, a focus on credit, ignoring the obvious.
We're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious. And it all feels good while it's happening, and then it doesn't feel so good once it arrives. Well, some of those changes have arrived.
So here's the latest this morning. Blackstone turning to internal executives to help cover the cost of a record redemption request. People familiar with the matter telling Bloomberg that Blackstone raised about $150 million from just 25 senior leaders to put towards withdrawals from the Blackstone Private Credit Fund. Tom Tzitzouris of Strategas writing, we continue to see more cockroaches in private credit, along with lingering stress in office space and commercial real estate. Tom joins us now for more. Tom, we're ignoring the obvious, and welcome. What are the obvious things that we're ignoring?
Well, I think the obvious thing that we're ignoring here is that what ties all of these things together, office space, private credit, the AI risk, and the threat posed by conflict in Iran, is if the yield curve steepens and even steepens back out to more normalized levels, you're going to have systemic credit risk. If the yield curve is allowed to remain relatively flat because the Fed maintains a big balance sheet and because the Treasury continues to issue T-bills rather than increasing coupon auctions, then we're probably not going to have systemic stress. But it's curve steepening that's the big risk.
So, Tom, this is really important, and Lisa and I spent the morning asking the very same question. Do you believe the risks in Iran right now and the market consequence of those risks materialising threaten to be an accelerant of what's playing out in credit?
They definitely do, but how we get there is you got to make some mistakes along the way. And by that, I mean, well, first of all, this conflict has to be prolonged. And as I think Jim Bianco had mentioned, if there's further damage to the oil infrastructure, that's also going to risk that we're going to see systemic risk in the U.S. But then you've got to see policy mistakes by the Federal Reserve. And I think a policy mistake would be to ease into that economic supply shock. That's a risk.
Why
now,
would
if the Fed eases, the curve is going to steepen and inflation expectations are going to have a chance to widen out and grow. And that's when you start to put pressure on places like private credit where their borrowing costs or their funding costs or their investors are funded in the 5 to 10-year portion of the curve, or even BDCs, where again, their funding is primarily in that 5-year portion of the curve, not the front end of the curve. So if the Fed eases into an energy supply shock that is prolonged, the curve is going to steepen and can steepen quite a bit.
Yeah, but Tom, even without that, we are seeing yields go higher, and maybe the curve is flattening, but still on an absolute level, 10-year yields have been rising in tandem with 2-year yields. It is resetting people's expectation for inflation, for baked-in premia that people will have to pay to ship goods. I'm looking right now at high-yield bond spreads, which have increased, oh my goodness, to the highest going back to November, still lower than 3 percentage points over benchmark rates. I mean, how much more do you see this having to reprice just by virtue of all the potential shocks coming down the pike and the potential for an acceleration of the cycle that we're already seeing play out?
You know, that's a great question. And for what it's worth, our forecast for 10-year yields is somewhere around a 470 to 480 by the end of the year. So based on what we saw the economy how we saw the economy playing out this year, we would say there's quite a ways to go for yields to push higher. But even just a return back to 430, that 430 to 450 range would seem to be in order. And that alone will probably put some further pressure on the credit space. Absolutely.
So what's the haven play here, Tom? Where do you go?
Well, unfortunately, we're still in a world where there's really not many havens at all in the fixed income space. You would want to be typically the ultimate haven in fixed income is short to intermediate duration investment grade corporates. We'll say 1 to 3 year A-rated, A+ rated paper typically has the lowest volatility profile, and that probably still is a haven. Beyond that, anything in the investment grade to treasury space, agency space, in the 0 to 2 year portion of the curve is where we would find safety in this type of economic scenario.
Hey, Tom, this was thoughtful. It's good to see you, buddy. Thanks for being here. Tom Tzitzouris there of Strategas. We keep returning to those 3 buckets, sources of risk right now: AI disruption, credit jitters, and geopolitical risk in the Middle East. 1 has informed 2. AI disruption has informed the credit jitters. How does 3, geopolitical risk, inform 2 as well? The credit problems. And it's the accelerant story that I think is an interesting one, the interplay between those 2 risks.
Those risks have gone in one direction, AI to credit risk, and then you have a third that just kind of has lingered out here as a separate entity. Does the third go to credit that then infects AI? Because that has been the ultimate question. If you get the credit taps turned off to the AI story, how much could that disrupt some of the build out and the price inelasticity that you've seen from some of these? I mean, it's a huge question, and these 3 are kind of coming together.
Yeah, in a big way, and potentially a much, much bigger way. But we keep going back to the same point. It depends how long this lasts. Now, when I ask the question, how long does it have to last for it to be a problem, we've actually had quite a wide range of estimates. The consensus seems to be several weeks, 3-4 weeks, bigger problems. Paul Sankey of Sankey Research said it's several days. You get to Friday, if that strait's not reopened, you're going to see production shut in and much bigger problems.
I could just hear Wall Street saying, but.
Of course,
the credit trading saying geopolitics never is the presiding factor in market performance.
That's the consensus position, and that's
Correct.
why we're around 2% away from all-time highs on the S&P. Up next, Meera Pandit of JPMorgan Asset Management, Jay Goldberg of Seaport Global, and the Fed Governor Stephen Miran, plus a briefing from the Pentagon. On the other side, the third hour of Bloomberg Surveillance just around the corner.
I think the price action's reasonable right now.
There's just too much uncertainty about these larger narratives.
I think it's a buy incrementally less America moment.
There's still some more room that you could fall.
The equity market is going to have a hard time making that next leg higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Here's the price action. Equities just about positive on the S&P, up by 0.1%. On the Nasdaq, up by 0.2. On the Russell, up by 0.4. Here's a snapshot of the commodity market. Brent and WTI volatile over the last 24 hours, pulling back now. We're down by 0.5 this morning on Brent. On WTI, we're down by 0.8 as we see some signs of support coming from the president on the traffic traffic going through the Strait of Hormuz. And a story from the New York Times supporting sentiment earlier on this morning as well, suggesting that over the weekend there was outreach from the Iranian side looking for an off-ramp.
Look, it's Whack-A-Mole Wednesday, because ultimately, on one hand, you've got the question of how much you get an off-ramp from President Trump, from Iran, at the same time that you have oil assets being potentially targeted and hit in the Middle East, questions about how much supplies are building. And as these headlines come out, throw in a little tariff dust for that. You see the whipsaw that's going on in markets as everyone tries to digest what the latest is.
Signal and noise. It's really difficult right now. Let's go to that piece from the New York Times. This is what they're saying, and I'll read it out to you verbatim, and you can decide what you think about it. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. That, according to officials briefed on the outreach.
So there are a couple of ways to take this. Number one, that President Trump didn't take this. Number two, it is unclear whether that person is still in the Iranian leadership, is still around. We don't have a sense of who's talking to who. There are a lot of question marks here, and it raises the specter of who ultimately will take charge in Iran should there be an off-ramp. How easy is it to find that?
So in just a moment, we've got a briefing, an important briefing that we'll take right here on Bloomberg Surveillance with the US Secretary of Defense Pete Hegseth and the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, taken to the podium in just a moment. And when they do, we'll bring you those comments. And I've got a few questions myself. One, of course, on the New York Times report. What was the outreach? Who is it from? What's the president saying about it? Can you share any details on that whatsoever? Don't know what they can say, but that question's got to be asked. Second one would be on the president's plan to escort ships through the Strait of Hormuz. Do you have the ability, the capacity, the spare capacity to lend those resources to make sure that can happen anytime soon?
Yeah, and does it include insuring some of those ships against losses? Is this a question of just the payment to compensate for potential damage done as ships go through the Strait of Hormuz? Will that be enough? I mean, people don't want the damage to begin with. Why would a ship operator want to subject themselves to that? Or is this actual military ships that will be accompanying the transshipment of goods through that strait? Look, there are a lot of questions. There's a lot of also questions about what the ultimate goal is of this conflict.
So we should get some details in the next 15 minutes about where we are with Operation Epic Fury. And then later on in the hour, we'll get some market reaction. Plus this on the Federal Reserve. Governor Miran, about 27 minutes away. What is the Fed's reaction function as this shock plays out in real time?
So far, Neil Kashkari of the Minneapolis Federal Reserve was speaking with Michael McKee yesterday and talked about how there was likely to be a greater degree of inflationary pressure that might push him away from cutting rates one time as he previously had expected. Will that be the same kind of tone? Probably not from Governor Miran.
Let's head down to Washington, D.C. now, so we can hear from the U.S. Defense Secretary Pete Hegseth alongside the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane.
Today with one unmistakable message about Operation Epic Fury. America is winning, decisively, devastatingly, and without mercy. Under the direct command of President Trump, the War Department unleashed this operation early Saturday morning, just 4 days ago, which means we need to remember two things. First, we are only 4 days into this. Metrics are shifting, dust is settling, and more forces are arriving. It's very early. And as President Trump has said, we will take all the time we need to make sure that we succeed. Second, we are only 4 days into this. And the results have been incredible. Historic, really. Only the United States of America could lead this. Only us. But when you add the Israeli Defense Forces, a devastatingly capable force, the combination is sheer destruction for our radical Islamist Iranian adversaries. They are toast, and they know it. Or at least, soon enough, they will know it. And we have only just begun to hunt, dismantle, demoralize, destroy, and defeat their capabilities, just 4 days in. Starting last night and to be completed in a few days, in under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. I hope all the folks watching understand what uncontested airspace and complete control means. It means we will fly all day, all night, day and night, finding, fixing, and finishing the missiles and defense industrial base of the Iranian military, finding and fixing their leaders and their military leaders. Flying over Tehran, flying over Iran, flying over their capital, flying over the IRGC, Iranian leaders looking up and seeing only U.S. and Israeli air power every minute of every day until we decide it's over. And Iran will be able to do nothing about it. B-2s, B-52s, B-1s, Predator drones, fighters, controlling the skies, picking targets. Death and destruction from the sky all day long. We're playing for keeps. Our warfighters have maximum authorities granted personally by the president and yours truly. Our rules of engagement are bold, precise, and designed to unleash American power, not shackle it. This was never meant to be a fair fight, and it is not a fair fight. We are punching them while they're down, which is exactly how it should be. Thus far, Operation Epic Fury has delivered twice the air power of shock and awe of Iraq in 2003, minus Paul Bremer and the nation building. The campaign has 7 times the intensity of Israel's previous operations against Iran during the 12-day war. 7 times. And as President Trump said, more and larger waves are coming. We are just getting started. We are accelerating, not decelerating. Iran's capabilities are evaporating by the hour, while American strength grows fiercer, smarter, and utterly dominant. More bombers and more fighters are arriving just today. And now, with complete control of the skies, we will be using 500-pound, 1,000-pound, and 2,000-pound GPS and laser-guided precision gravity bombs, of which we have a nearly unlimited stockpile. We used more exquisite standoff munitions at the start, but no longer need to. Our stockpiles of those, as well as Patriots, remains extremely strong. The enemy can no longer shoot the volume of missiles they once did, not even close. And the chairman will lay out some of those percentages. So our air defenses and that of our allies have plenty of runway. We can sustain this fight easily for as long as we need to. And as I said yesterday, we set the terms. Now, you may not see much of it because the IRGC shut off the internet to the entirety of the country. They blind their people on purpose, just like they kill their own on purpose. Much was made of the volume of missiles Iran was able to shoot in the first few days. And sadly, as we projected, a few got through and killed 6 of our best, who will hopefully arrive home soon. We will avenge them, no doubt. But I liken Iran's predicament to a football team who scripted the first 20 plays of a game. The team knew what plays to run because their first few drives were scripted. But now that the game has started and the blitz is on, they don't know what plays to call, let alone how to get in the huddle and call those plays. Iran's senior leaders are dead. The so-called governing council that might have selected a successor, dead, missing, or cowering in bunkers, too terrified to even occupy the same room. Senior generals, mid-level officers, enlisted ranks, they can't talk or communicate, let alone mount a coordinated and sustained offensive. That's not great for morale. The Iranian Air Force is no more, built for 1996, destroyed in 2026. The Iranian Navy rests at the bottom of the Persian Gulf. Combat ineffective, decimated, destroyed, defeated, pick your adjective. In fact, last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice. Their Navy, not a factor. Pick your adjective, it is no more. In fact, yesterday, in the Indian Ocean, and we'll play it on the screen there, an American submarine sunk an Iranian warship that thought it was safe in international waters. Instead, it was sunk by a torpedo. Quiet death. The first sinking of an enemy ship by a torpedo since World War II. Like in that war, back when we were still the War Department, we are fighting to win. Also, yesterday, the leader of the unit who attempted to assassinate President Trump has been hunted down and killed. Iran tried to kill President Trump, and President Trump got the last laugh. Now, this is not a mission accomplished situation. This is simply a reality check. The combination of U.S. and Israeli intelligence and combat power will control Iran, and will control it soon. Sure, Iran will still be able to shoot some missiles and still be able to launch one-way attack drones at civilian targets, and their proxies will attempt to attack our embassies, bases, and soft targets. They are terrorists, after all, and they need to target civilians because they can't fight toe-to-toe. But we will find them, and we will kill them. This is what the fake news misses. We've taken control of Iran's airspace and waterways without boots on the ground. We control their fate. But when a few drones get through or tragic things happen, it's front page news. I get it. The press only wants to make the president look bad, but try for once to report the reality. The terms of this war will be set by us at every step. As I said Monday, the mission is laser focused. Obliterate Iran's missiles and drones and facilities that produce them, annihilate its navy and critical security infrastructure, and sever their pathway to nuclear weapons. Iran will never possess a nuclear bomb, not on our watch, not ever. And this is why President Trump's moral clarity on Iran today is so vital. Unlike the past, where vague red lines and endless negotiations let Iran fund terror and inch ever so slightly toward a bomb, this president sees the threat plainly and acts decisively. No more half measures, especially when Iran is at its weakest. No more letting Tehran play for time while our people pay the price. His leadership ensures that we finish what we start and that we protect our warfighters by crushing the enemy before they can strike again. Our offensive operations, refined through months of relentless preparation, are unstoppable. And our defensive efforts are unprecedented. We have from the start put the protection of our troops ahead of everything else. Before we very publicly built up offensive combat power, we quietly ensured that our defensive posture and power was in place. And as we built up offensive combat power, we moved the vast majority of American troops, over 90% of Americans that were on our bases, what we say off the X, out of the range of Iranian fire. Our defensive shield is equally formidable, the most sophisticated air and missile defense network ever fielded. Thousands of Iranian missiles and drones have been intercepted and vaporized. Tens of thousands of American and allied lives protected. We have pushed every counter-UAS system possible forward, sparing no expense or capability. And like I said, this does not mean we can stop everything, but we ensured that the maximum possible defense and maximum possible force protection was set up before we went on offense. In closing, as President Trump told German Chancellor Merz yesterday, Iran negotiated in bad faith, stalling, scheming, and preparing to strike. And we acted decisively to defend our people, our interests, and our allies. President Trump took bold action, putting America first, the kind of bold action that the American people elected him to execute. To our steadfast partner, Israel, your mission is being executed with unmatched skill and iron determination. Fighting shoulder to shoulder with such a capable ally is a true force multiplier and a breath of fresh air. We salute your courage and your contribution. 4 days in, we have only just begun to fight. America fights to win, and in Operation Epic Fury, we are. May God's providence cover and protect our troops always. And with that, I turn it over to the chairman.
Thank you, Mr. Secretary, and good morning, everyone. Thank you for being here. I'm here today to provide the American people and those of you in this room an update on Operation Epic Fury. First, it's with profound sadness and gratitude that I share the names of 4 of our 6 fallen heroes, all from the 103rd Sustainment Command, U.S. Army Reserves out of Des Moines, Iowa. Captain Cody Cork, Sergeant First Class Noah Tegens, Sergeant First Class Nicole Amore, and Sergeant Declan Cody. To the families of our fallen, we grieve with you today, and we look forward to welcoming your family members home at Dover in the coming days. Out of respect for the other families, we'll withhold the release of their names until next of kin notification is complete. And either myself or Admiral Cooper will release those names as soon as we can ensure that all of those families have been properly notified. To our Gold Star families, to our wounded warriors and their loved ones, we will never forget your sacrifice. Our nation stands with you, and we are eternally grateful for your courage, your resiliency, your devotion to this mission and to our nation. As the Secretary said, we're 4 days in, 103 hours into this campaign. The operation was again launched with clear military objectives designed to dismantle Iran's ability to project power outside of its borders, both today and in the future. First, we are targeting and eliminating Iran's ballistic missile systems to prevent them from threatening the U.S. Forces, partners, and interests in the region. Second, we are destroying the Iranian Navy, degrading its capacity, capability, and ability to conduct operations, not just in the Central Command AOR, but as the Secretary showed in the video, around the world. Third, we're ensuring Iran cannot rapidly rebuild or reconstitute its combat capability or combat power, and those phases will begin as the campaign continues. As of this morning, U.S. Central Command is making steady progress. Iran's theater ballistic missile shots fired are down 86% from the first day of fighting, with a 23% decrease just in the last 24 hours. And their one-way attack drone shots are down 73% from the opening days. This progress has allowed CENTCOM to establish localized air superiority across the southern flank of the Iranian coast and penetrate their defenses with overwhelming precision and firepower. We will now begin to expand inland, striking progressively deeper into Iranian territory and creating additional freedom of maneuver for U.S. forces. Let me explain a little bit about how we're thinking about staying ahead of the enemy. First, over the past several weeks, Admiral Cooper and the CENTCOM team have refined their operational approach to the region. Their planners identified key centers of gravity that would allow Iran to project power outside of its borders. They thought about how to isolate critical vulnerabilities and determined where, with precision, the greatest strategic effect could be achieved. As a result of this, CENTCOM is now shifting in day 4 already from large, deliberate strike packages using standoff munitions at range outside an enemy's ability to shoot at us, now into stand-in precision strikes overhead Iran. As the Secretary said, this is a point of munitions transition from standoff munitions to stand-in munitions like Joint Direct Attack munitions, which are GPS-aided free-fall weapons, and other things like Hellfires, etc. This will allow the joint force to deliver significantly increased precision effects on the target. The throttle is coming up, as the Secretary said, as opposed to ramping down. This will allow us to maintain consistent pressure on the adversary over the coming days, disrupt their launch timelines, and impose cost every day around the clock. I know there have been a lot of questions about munitions. We have sufficient precision munitions for the task at hand, both on the offense and defense. But I want to tell you, teammates, as a matter of practice, I don't want to be talking about quantities. And I know there's been a great debate about that, and I appreciate the interest, but just know that we consider that an operational security matter. Let me flip to the map here. Hopefully I don't kill anybody with a laser pointer. As I mentioned earlier, and for you with the camera right there, my friend, I hope I don't ricochet off and hurt you. Over the initial days, the U.S. Joint Forces continued to attack and attrit ballistic missile capabilities as well as integrated air defense capabilities along the southern axis. Along the northern axis, Israel and the Israeli Air Force has predominantly been working integrated air defense targets along the northern flank, as well as medium-range ballistic missile capability as well. From the sea, the USS Ford has continued to project combat power here, as well as the bomber pulses that we talked about in the opening days of this briefing. Along the southern axis, the USS Abraham Lincoln Strike Group has continued to provide pressure from the sea along the southeastern side of the coast and has been attritting naval capability all along the strait and up into the Arabian Gulf at a size and scale sufficiently to address the targets required. To date, we've hit over 2,000 targets, as Admiral Cooper said in his video last night. We've destroyed more than 20 Iranian naval vessels, including, in addition to the frigate outside of the area, one submarine, and effectively neutralized at this point in time Iran's major naval presence in theater out there. As the Secretary showed the video, for the first time since 1945, a United States Navy fast attack submarine has sunk an enemy combatant ship using a single Mark 48 torpedo to achieve immediate effect, sending the warship to the bottom of the sea. I want to remind everybody that this is an incredible demonstration of America's global reach. To hunt, find, and kill an out-of-area deployer is something that only the United States can do at this type of scale. Over the next 24 to 48 hours, CENTCOM will continue to strike infrastructure and naval capability, and will continue to assess our progress against the military objectives. It does take time for us to collect that information and to assess en route. Much of our intelligence, surveillance, and reconnaissance capability is currently hunting and killing ballistic missile launchers and one-way attack capability. We're precise in that assessment, and we call balls and strikes in that assessment. We take that matter seriously. Iran, on the other hand, has been indiscriminate and more imprecise in their attacks. They fired more than 500 ballistic missiles and more than 2,000 drones, striking innocent civilian targets throughout the region. Our partners are answering the call to defend themselves right alongside us. Jordan, Bahrain, Saudi Arabia, the UAE, Qatar, and Kuwait are all defending their people with their own combat capability, with precision and restraint. Jordanian air defense crews recently intercepted a cluster of Iranian one-way attack drones headed to Amman. Bahrain's air defense forces shot down an inbound drone approaching Manama's maritime infrastructure, protecting both their population and critical shipping lanes. Saudi Patriot batteries stopped a salvo of ballistic missiles aimed at energy facilities near Dhahran. The UAE neutralized multiple drones targeting Abu Dhabi's industrial zone, demonstrating speed and precision. And Qatari fighters for the first time have shot down 2 Iranian bombers that were en route to their location. Together, these nations are helping to defend themselves and project power as required against the enemy. We're 100 hours in. It's still very early, as the Secretary said, but the balance is shifting. We've always got to remember that these operations are complex, dangerous, and far from over. Our soldiers, sailors, airmen, Marines, Guardians, and Coast Guardsmen remain in harm's way, and we must be clear-eyed that the risk is still high. This is combat. Let us never forget this. As we continue, I ask that we hold all of our deployed teammates in our thoughts, those standing the watch, flying the sorties, sustaining the fight, and carrying our nation's burden. And I'll stop where I started, and that's remembering our 6 fallen who will return home as soon as possible. I remain humbled, grateful, inspired by every day the valor and professionalism of our joint force. They are quiet professionals through and through, out there doing America's work. through the day and through the darkness. And with that, I'll take your questions along with the Secretary.
We've been tracking the press briefing at the Pentagon down in Washington, D.C. We'll continue to track the headlines that come out of the Q&A portion of that conference, alongside the U.S. Secretary of Defense Pete Hegseth there, alongside General Dan Kane. Two notable headlines that came out of that. One from the Defense Secretary, that U.S.-Israel have complete control of Iranian skies. And two, from General Dan Kane, the U.S. is shifting from large to precision strikes over Iran.
As they do get complete control over the skies, the initial move in markets seemed to suggest that people were taking the general and Pete Hegseth at their word, frankly, discussing exactly what would happen and getting some comfort from that. Still some questions, and I'm sure that they'll be getting them about what the goals are in terms of not just eliminating the nuclear threat, but also exactly what they would like to constitute the government or the establishment to prevent any kind of reestablishment of the nuclear program in particular.
It's fair to say this is a fluid situation. So far, going into the cash open, futures are still positive by a third of 1% on the S&P. Likewise on the Nasdaq. In the bond market, bond yields look like this. Yields are higher by a single basis point on a 10-year. We did get an ADP report out just moments ago. That was an upside surprise. And an update on the move in energy. Crude, slightly negative. We're down by 0.2%, but still in the 80s on Brent. Brent crude at 81.21. With us around the table, tracking that briefing, Meera Pandit of JPMorgan Asset Management. Meera, good morning.
Good morning.
What are your thoughts on the shock over the weekend, how things are developing and what it means for your world?
Seeing that press conference, you are seeing that we are projecting power and strength and control, which I think is a calming factor to the markets. But the reality is there was also a comment about as long as it takes to succeed. And that is the biggest concern for the markets of how long does this go on? And perhaps there is increasingly going to be some separation between how long does the conflict continue and is there some liquidity, fluidity through the Strait of Hormuz that just gives us enough relief to put a little bit of pressure off of markets. But overall, as we take a big step back and, we continue to debate, is this days or weeks or months or years? Ultimately, from our perspective now, thinking about more of the weeks calculus here, our expectation is that it will be modestly inflationary, but likely not stagflationary, because you still have the benefit of timing here around the One Big Beautiful Bill Act and the stimulus payments to consumers and taxpayers, which essentially will alleviate some of this pressure if we have upward oil prices, which so far have been relatively well contained. But you do think about some of that putting a bit of upward pressure on inflation. Now, as it is, we were expecting that inflation would peak about 3 or more percent by the midpoint of the year, given tariffs, given elevated tax refunds driving up demand and therefore prices. So this reinforces that view, but I don't think it makes it a step function worse yet.
This is one of three risks we've discussed all morning on this programme, the other two being AI disruption and the credit jitters. Do you see those risks accumulating into an index-level threat? Because at the moment, around 2% away from all-time highs, it looks like we're doing OK.
We are experiencing somewhat of an index level threat as it is, because even though we're roughly flat on the S&P 500 and have skirted around that for the most part of the year, you do see that tech is still down 5 or 6% year to date. And yet, on the other hand, you have 5 different sectors that are up double digits year to date. And again, this isn't 2022 where it's just energy that's being the big driver here. You're still seeing industrials, materials, consumer staples as other big winners so far this year. So you have seen that rotation. It's just challenging in such a concentrated index where tech has been such a big part of it to see those stocks look a little bit weaker. But ultimately, I still think it's a rotation around AI from who are the innovators around technology to who are the beneficiaries of that CapEx and where is that infrastructure layer coming in. Again, it's just a little bit less of a weight in the index to have that power to drive it forward. But very much the conversation around AI has flipped from, are we overestimating AI and is it a boom and soon to be a bubble, to are we underestimating the power of AI? So we continue to cycle through these different existential fears, which does create an issue for the markets ultimately that I think we'll look back on in 2026 and say it was this tension between sentiment and fundamentals, where the fundamentals within the market this year and so far in the economy still look strong, but the sentiment clearly is anxiety-ridden.
Well, I guess to build on where John was going with this, part of the issue that people have this morning is the first part of what you were talking about, which is the inflationary aspect of this. It wouldn't be stagflationary, it would be inflationary, which potentially could really create an obstacle for the Federal Reserve to cut rates even once, let alone twice, and could potentially pressure some of the credit jitters that we've already seen that are working their way through the system. How realistic do you see that? A tightening in financial conditions due to the inflation that could dampen some of that growth that you were talking about?
Relative to 2022, I think this time around we do have to separate headline and core inflation. Because if you do see headline inflation a bit elevated, but core inflation is still experiencing some of these disinflationary trends, then the Fed still may feel comfortable putting in a cut, especially depending on how the labor market continues to shape up. Relative to 2022, what we forget is, yes, there was an inflation spike, but it was all across the board. It was not just the oil prices and the food prices related to geopolitics, but also you still had very strong core goods prices, very strong services prices, which we're not seeing to that same extent today. So there was no room for the Fed to do anything other than stay in one direction, hiking rates, whereas this time around, we do have core inflation potentially looking a little bit softer in the back half of the year.
Sometimes when the threat is big enough, the decision is obvious. And right now, I don't think the decision is that obvious for the committee at the Federal Reserve.
Which makes it that much more difficult, given the fact that they have a hawkish bias. That's what we heard earlier. Based on what we saw in 2021 and 2022, they were burned by inflation. They don't want to be burned again.
Meera Pandit at JPMorgan Investment Management. Meera, good to see you. Thank you. I mentioned that ADP number dropping just moments ago. Upside surprise 63K, the estimate 50 with the details. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, it's kind of interesting because ADP, you've seen the numbers, found 63,000 new jobs for the private sector. And the consensus so far for non-farm payrolls of economists we've surveyed for private sector jobs is 65,000. So very, very close. However, remember last month, 172,000 private sector jobs were created, and ADP's revised number for last month was 11,000. So big miss last month. We'll see if they're any closer this month. They do show of that 63,000, 58,000 are in the healthcare area. So that hasn't changed. The sectoral dispersion of job creation is still very, very narrow out there. In terms of the payroll situation for job changers, 6.3%, that's down. Job stayers get a change of 4.5%. That's unchanged from the month before. So still no price pressures or wage pressures out there.
Mike McKee, thank you, sir. Looking ahead to the payrolls report on Friday, the next big stop for the labour market debate. The bond move continues, yields slightly higher for a third consecutive day. Inflationary fears making a comeback, and some people out there trimming Fed rate cut bets. Federal Reserve Governor Stephen Miran, I'm pleased to say, joins us around the table for a conversation about that and a whole lot more. Governor Miran, good morning.
Good morning. Thanks for having me.
Thank you for being here, sir. Let's start with the shock over the weekend. What is the prudent response for policymaker confronting a shock like the one playing out in the Middle East?
Well, at the moment, I think it's too early to sort of have any firm views as a result of that. Oil's gone up a bit, but the major question is, does oil stay up or does it come back down? And that, of course, will depend on how things play out. But even that said, even if oil stays at these types of levels, to me, it's difficult to get a lot of read-through as a result of that. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
So some people who come on the programme spoke to Lisa and I and said these Federal Reserve officials might be conditioned by the post-pandemic experience coming out of 21 into 22 and the inflation spike then and the energy shock that developed at the time emanating in Russia. Is this different? Are we in a different place?
I think it is. I think that attitude is a little bit of fighting the last war. And I think that the Federal Reserve for decades has had the view that, that headline inflation shocks like oil are best looked through, and you sort of focus on core inflation because it's indicative of where inflation is going to go in the future, and you focus on the labor market. And that type of reasoning leads you to look through an oil shock. Now, of course, what happened in 2022 was a bit different because the other policy settings were different, right? Don't forget, monetary policy was as expansionary as it had ever been at the time. Fiscal policy was injecting trillions of dollars into an economy that was recovering thanks to vaccines and medical improvements and COVID passing on its own. And so the policy environment was very different. And so it was very easy for a slightly inflationary shock to feed through into the broader economy and create this type of persistent inflationary problem that the Fed dealt with. We don't have that right now. We don't have fiscal policy that's slamming on demand. In fact, if anything, supply is moving out quite aggressively, and monetary policy is still modestly restrictive in my view. So the policy settings, the economic environment is different. To focus on that, as you described a moment ago, to me, is fighting the last war. That was a unique circumstance.
At the same time, some people have argued that the January jobs report raised a question about just how weak the labor market actually was. Even Governor Chris Waller came out and said, OK, now it's a coin flip for whether we should cut rates at the March meeting. If we do get confirmation of that strength with the February payrolls report that we get on Friday, would that make you rethink whether March was an appropriate time to cut rates?
So look, for me, we've got 2 years of a trend, 2+ years of a trend of gradually weakening labor markets that sort of set in 2023. It's way too early to reject the notion that that trend continues based on 1 or 2 labor market reports. And when you look at the totality of labor market data, there's still evidence to me that it needs more support from monetary policy. When I look at things like employment levels of young folks and folks without college degrees, when I look at people who are unemployed for long periods of time, long-term unemployment, to me that's indicative of there still being slack in the labor market that monetary policy can accommodate. So I think it's too early to reject the notion that a 2+ year trend is over on the back of one print.
Are you concerned, though, that right now the market is moving the way that any rate cut would be perceived as heightening long-term inflation pressures, just by virtue of some of the supply shocks that we're seeing, and frankly, the fact that people do see strength reemerging in certain pockets of the economy? I mean, how worried are you that a rate cut in March could be potentially counterproductive and cause the long end of the yield curve to rise?
Yeah, so if you saw evidence in inflation markets that markets were concerned about long-run inflation expectations, that's the type of thing that would give me pause. But I don't see evidence of that so far. Short-run inflation expectations have come up quite a bit when you look at CPI swaps, but that's just because of the mechanical read-through of oil prices into headline inflation. When you look at longer tenors, there hasn't been much of a move. And so as a result, I don't get the impression the market is concerned about long-run inflation expectations.
You've used this phrase modestly restrictive a few times in this conversation already. What is modestly restrictive to you? Can you put numbers on that kind of thing?
Yeah, I think we're probably about a point above neutral now. And so my view is that we ought to start by getting back towards neutral.
So the 100 basis points in reductions you want this year is not to become accommodative. You believe it's to get back to a neutral setting?
Yeah, pretty much.
What would it take for you to start thinking about the need to get accommodative?
So I would want to start thinking about inflation coming in below the target, which is a risk that I've highlighted. If I end up being, I've emphasized
housing. What's the source of that risk, Governor? What would be the source of that risk to get below target inflation?
Sure, I've emphasized housing markets a lot, that I'm expecting a faster convergence down of renewal rents to new rents, which will lead housing inflation to converge quickly to new rent levels. And there's reasons for that I've talked about at length. I don't need to repeat them here unless you want me to. But if I end up being right about housing and wrong about tariffs, and so I've also argued that I don't view tariffs as driving goods inflation. I don't view that because imported good prices are not inflating faster than all good prices, which is what you would expect to see. And given that backdrop, I don't view tariffs as driving goods prices. So if I end up being right about housing and we get a sharp deceleration in housing this year because of quirks of how housing is measured and because of dynamics of renewal rents versus new rents, and I end up being wrong about goods prices and goods inflation comes down quickly over the course of this year, then we're going to undershoot. Our target.
And you think that's a risk we need to get ahead of?
No, I'm not saying we need to get ahead of that. That would get me to argue we go below neutral.
That's the conversation we're having about how preemptive you might need to be in a moment like this, when others on the committee are thinking, let's wait and see what happens. Lisa was asking, how would you vote at the March committee meeting? Is this a moment to wait and see or a moment to act?
No, I think it's a moment to continue acting. I have projections for unemployment. I have projections for labor market. So do for inflation. So do my colleagues. And I believe it's appropriate to continue acting in accordance with those projections until you get evidence that you have to change your projections. And thus far, the evidence from events over the weekend haven't led me to change any of my forecasts for the labor market for inflation over the medium term. So it's too early to respond to them.
You said that you think that the neutral rate is a point below the 3.75 where we currently are, and I'm just wondering how quickly you think it's important to get to neutral based on the uncertainty, based on the disagreements that people have about A, where neutral is, and B, how things are going to transpire.
Yeah, so last year I was voting for 50s because we were higher away from it. And then as we made progress cutting and getting closer towards neutral, I felt it was appropriate to say, okay, moving in 25 clips. I'd prefer to still continue moving in 25 clips until we got to neutral and then to reevaluate. Because at the end of the day, I don't see an inflation problem in the United States. Now, of course, if we get evidence that what's happening in the Middle East is bleeding through into broader inflation, then that would change my mind. But thus far, there's no evidence.
Quickly, Governor, what would that evidence look like? What would you look for specifically?
I'd look for inflation expectations starting to move as a result, starting to move in a durable way.
Market-based or consumer-based?
I tend to think that the market-based ones are more important to me, or evidence the economy is starting to, in some sense, overheat again. Then I would be comfortable sort of changing that view and moving even more slowly. But at the moment, I see it as appropriate to continue cutting.
Do you have any company on the committee?
I can't speak for anyone else, and I think most people probably end up sharing my view that it's too early to draw dramatic conclusions as a result of what's happening.
But they come to a very different conclusion about what to do as a result of not drawing conclusions. They say, okay, well then don't move. You're saying keep moving. So I mean that's
they started in different. Everybody is. I think people are generally where they were last week, right? And it's just too early to change your mind based on what's going on. My forecast for inflation and unemployment, in my view, call for continuing interest rate cuts. Other people disagree, and so they also haven't moved yet. But as we get information, they'll update.
Two more things to work through.
Yeah.
So the credit jitters one, and AI another. I want to squeeze them both in if we can. So let's start with the AI jitters. So Block, a fintech company, came out in the last week or so and cut almost half of its staff. And they said they're making a massive AI productivity bet. As a policymaker for you, do you consider that noise or signal? What is that?
So that's one company. It's indicative of what you could have more of. But this is how productivity gains in technology work. They allow you to produce more with fewer inputs, with fewer resources. And so if you were able to produce the same amount with fewer workers and less capital, then your productivity goes up. That frees those workers not necessarily into unemployment, but to do other work. And this has always been the story of human technological progress and human economic growth. We create new technologies, they destroy some jobs, and then they create new jobs. They free people to do new activities.
You don't think it's different this time?
I don't have a reason for, like I said before, it's too early to reject a 2-year trend of labor market moving in a gradual cooling direction. It's too early to reject a tens of thousands of years trend of how technology works in the economy.
We've talked about these sources of risk, and one has been the geopolitical problems. This is another too, and the third one is connected in some cases to what's happening with AI. It's also the credit jitters as well. So this raises the question about potential financial risk for you in the committee. How are you thinking about things as they develop?
But just one last point on AI. Even as AI destroys old jobs and creates new jobs, that is the type of job transition that is typically accommodated by a central bank, right? You don't want to prevent the new jobs from being created by having policy that's too restrictive. If you have an increase in job loss due to new technology, you have to accommodate that and allow the new jobs to get created instead of preventing it.
Do we need to support what's developing in credit?
I'm sorry?
Credit. Support what's developing in credit?
So look, I am, like with events in the Middle East, I'm not at the point where I have a strong read-through from what's going on in credit into the economy. I'm not at the point where I think there's any sort of policy response that's necessary or adjustment to forecast that's necessary. One thing that I think is interesting about what's going on in credit is, to me, it highlights a potential shortcoming of our financial conditions indices. We've got a lot of people who argue it's inappropriate to cut because financial conditions are so loose. They've been arguing that for a long time. But one hypothesis of mine that I'm exploring is that those financial conditions indices aren't showing you what's going on in private credit because you don't get the marks for them. And to the extent that private credit has been a major driver of credit growth over the last half decade or so, that's missing from the financial conditions indices. So when we get these jitters in private credit markets and then say, oh, financial conditions are so loose, it's just because we've decided not to look at the part of the financial markets that are tight.
So do you think we are seeing an unwarranted tightening of financial conditions so far?
Well, sort of unwarranted is a bit of a heavy load, but I do think I would be cautious about concluding that financial conditions are so loose when you're getting these things happening in private credit markets.
I just want to ask, have you talked to President Trump recently?
Not since I resigned.
Not since you resigned. I'm just wondering how difficult it is to conduct policy with a huge unknown hanging over the committee about who is going to be the next Fed chair and what this process is going to look like past April.
Well, I mean, I think we have a pretty good idea of who's going to be the next Fed chairman. We don't have a good idea yet of exactly when he will become the next Fed chairman, but I'm hopeful that we get that type of clarity soon. I think it would be great to have that type of clarity.
Governor, is it weird being on the Federal Reserve and not knowing when you're going to exit? You're just sort of like there with an open-ended calendar on what's going to happen next.
It makes it difficult to plan.
I bet it does. For personal reasons. Governor, it's good to see you.
Thanks for having me.
Thanks for making time for us. We appreciate it. Governor Stephen Miran there of the Federal Reserve, responding to a range of issues, and we keep going back to the same three: geopolitics, credit, an AI disruption.
And at what point do they intersect? And are we starting to see a little bit of connection between the three? It will continue to be the question.
Let's turn to the financial markets then and get you an update on things. Equity futures right now, the S&P 500 positive by 1/3%. In the bond market, yields slightly higher, 10's up by almost a basis point, just north of 4%. And in the commodity market, crude slightly lower, down by 1/3% on Brent to 81.15. With an update on stories worldwide this morning, let's get to your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. ADP data showing U.S. companies added the most monthly jobs in February since last July, an encouraging sign for the labor market. Private payrolls came in at 63,000, well above estimates of 50,000, and a big rebound from January's total of 22,000. Service-producing jobs accounting for the bulk of the figures, with 47,000 jobs added. Meanwhile, Defense Secretary Pete Hegseth saying the U.S. and Israeli assault on Iran is accelerating. In a press briefing earlier this hour, Hegseth adding the countries are dominating Iran from above.
In under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. The Iranian Navy rests at the bottom of the Persian Gulf. Last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice.
Hegseth also saying the U.S. can easily sustain the fight with a nearly unlimited stockpile of precision bombs. And Goldman Sachs CEO David Solomon saying he's surprised by the benign market reaction to the Middle East conflict. Speaking at Goldman's first ever Australia Week, Solomon saying it will take a couple weeks for markets to truly digest the implications of the situation. We'll hear more from Goldman Sachs CEO on Bloomberg TV at 5:45 p.m. Eastern. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. Appreciate the update. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Tyler Kendall, the latest from Washington, and Ed Ludlow previewing the president's meeting with big tech executives later on today. From New York City, you're watching Bloomberg TV.
Even if oil stays at these types of levels, to me, it's difficult to get a lot of read through it. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
That was the Fed Governor Stephen Miran. Steve joining us just moments ago, weighing in on Fed policy. In his own words, in many ways, nothing has really changed for the Federal Reserve over the last week, at least for him. If you want to wait, you still want to wait. And if you want to cut, you still want to cut. And that man still wants to cut interest rates. Equities at the moment on the S&P 500 going into the opening bell firmer by 0.4%. Near session highs on the Nasdaq up by 0.6, on the Russell up by 0.8. In the bond market, a little bit of stability. Largely unchanged across the curve. 10s at just north of 4% at 4.06%. And in commodities, the highs of the week, the highs of the year were 24 hours ago, 24 hours plus now, at $85 a barrel. Right now on crude, we're pulling back by more than 1%, $80.50. The situation is fluid, the market's volatile, but at the moment we're pulling back from recent highs. On WTI, we're down by 1.6, 73.40. As we count you down to the cash open, here's the trading day. The week ahead looks like this. At 1 p.m. Eastern Time, a White House press briefing. At 2 p.m., the Fed's beige book. 3 p.m., tech executives meeting with President Trump at the White House for a roundtable on power payments. After the closing bell, earnings from Broadcom. Thursday, another round of jobless claims plus results from Costco. And on Friday, the payrolls report is just around the corner. Elsewhere, the U.S. Secretary of Defense Pete Hegseth saying armed forces control Iranian airspace and the operation will move to more precision-guided bombs. Bloomberg's Tyler Kendall joins us now from the White House for more. Tyler, welcome to the program. What did you make of that briefing 30 minutes ago?
Hey, John, I mean, at this point, it seemed absolutely clear that U.S. officials are intent that this military campaign will be sustained. We heard Secretary Hegseth really emphasize the idea that the U.S. and Israel now have what they are calling uncontested control over Israel's airspace. I'm sure you picked up on this quote, but we heard the secretary say, quote, "We are just getting started. We are accelerating, not decelerating." Now, he did outline that the U.S. feels it has plenty of stockpiles to sustain this fight, something that President Trump himself has emphasized as well, though we did hear U.S. officials decline to specify the quantity, saying that that would be an operational risk. Now, on the operational front, we also heard, as you mentioned, that the U.S. says it's going to go deeper into Iranian territory, and John, that will be the next phase.
Tyler Kendall down in Washington. Tyler, appreciate the update. Also taking place in the nation's capital today, big tech executives heading to the White House set to sign pledges to foot the electricity bill for energy-hungry data centers. Ed Ludlow joined us now for more. Ed, they're going to be on the hook and the pressure is building.
Yeah, they are. Very simply, this president wants the hyperscalers to pay for the energy that they need. Either they pay for it, they build the supply, or they bring it through another mean by localizing the power supply to that data center at scale. And if you go back to last July, when the president launched the sort of AI action plan, the emphasis was very much on cutting red tape, deregulation, expedited permitting, allowing those names on your screen to move quickly. But when we came to the State of the Union address, affordability is clearly top of mind. And so there are a wide range of policymakers, utilities, the hyperscalers themselves that argue that if they take on the upfront cost of modernizing the grid and spread the investment over the grid, you could lower the cost of home electricity prices by a few percentage points per gigawatt. But it's very hard to believe in that. When you look at the zip codes on the eastern seaboard where data center capacity has already expanded and what prices for everyday Americans have done in those areas and jurisdictions. But that's the trade-off here. And so the names expected are the hyperscalers, OpenAI, Meta, XAI, etc. And the president will get them to sign what is a pledge. It is a pledge, and it's called the Ratepayer Protection Pledge. But then they have to take that capital expenditure and do something with it.
Just quickly, where's Anthropic and what's happening?
Yeah, I mean, CBS is reporting that the U.S. military apparatus continued to use their technology over the weekend. But as it stands, the status quo from the president himself is that there is a ban on them as a supplier. So we need some certainty from the company on that. But, they are taking the moral high ground here and clearly have a set of red lines for how they feel their technology should or shouldn't be used. I'd encourage the audience to go and read the Bloomberg reporting on how OpenAI has positioned this, because Sam Altman has been communicating to his employees and publicly about their approach here.
Ed, looking forward to the programme a little bit later this morning. Bloomberg Technology, a few hours away. Ed Ludlow there. Coming up tomorrow on this programme, Noel Dixon of State Street, Tom Kennedy of JPMorgan, the Richmond Fed President Tom Barkin, and Michael Gapin of Morgan Stanley. From New York City this morning, good morning. Best of luck for the rest of the trading day. From New York, this was Bloomberg Surveillance.